at a regional level, and this is stage 3, which is the national finals. So out of 1,000 students, we have 18 here, 9 teams which are competing for the finals. We've really been witness to them putting in a lot of fight, lot of effort over the last 2 to 3 months, and honestly we've been blown away by the kind of preparation and the kind of talent that we've seen. We hope you'll have a good time. The teams have put in a lot of effort, and all the best to them. We'll start off immediately. The format is as follows: 10 minutes for presentation for each team, followed by 5 minutes of Q&A, and we'll stick to a very tight schedule. Once the teams finish presenting, they can join the audience. Before that, they'll wait outside. And the draw, we've decided the order of presentation based on a draw of lots, and we'll just start along those. That's basically the rules. So without much ado, let's start. Okay. So guys, we'll request the teams who are not presenting to move out. We'll start. The first team, Bhavya and Anirudh. Bhavya Agarwal, Anirudh Banga from JNS Bombay.
Hello. Hello, hello. Hello, check. Just speak. Just speak. Just speak. Press it.
Hello.
You're audible.
Good morning, ladies and gentlemen. My name is Anirudh Banga.
And I'm Bhavya Agarwal.
And we are the founders of Kazoom. Kazoom is a D2C fast fashion asset light brand. For this, it is a limited liability partnership. Sorry. So for this model, what we have assumed is that we have taken a financial model for the prediction for 8 years from FY27 to FY34. You can look at the screen, of course, as we talk. One of the more important points is that the target audience for this fast fashion brand is from ages 14 to 24, and we sell 3 primary SKUs. They are our t-shirts, which is our hero product. These are a revenue generating beast that we sell from year 1. We have hoodies that we introduce in year 2 and caps in year 3. We'd like to move on to the key assumption sheet. So the key assumption sheet, as is quite obvious, key assumption sheet contains all the metrics that we have used for our calculations. It is essentially the control panel of our entire model. Any values changed here reflect in the entire model. I invite you to take a minute to just have a look at it.
Yep. Alright, I will be presenting some important graphs from our model. Firstly, you can see our first graph over there, which is our CAC versus our lifetime value of a customer. As you can see, as the years pass, our CAC reduces while our lifetime value of a customer increases. This shows that we are not just buying customers, we are getting better at keeping them. Our second chart shows our conversion rate versus our CAC. As you can see, our conversion rate keeps on rising. This proves that a consumer-centric growth engine is operating at a great level. Our flywheel is becoming more faster and more efficient. Now here you can see is our profitability profile. It shows the revenue versus the EBITDA growth. Now moving on to a very important graph, the fourth graph shows the yearly FCF versus the cumulative FCF. As you can clearly see, for the 7 years of operation, we are negative at FCF level. However, at the 8th year, we turned positive. We are able to wipe out almost all of our cumulative FCF losses. A little bit is left that can easily get wiped out in the next year. Below here are our 3 waterfall charts that show our unit economics of all of our 3 SKUs, our t-shirts, our hoodies and waterfalls, and our caps. These are for the FY34, which is the 8th year of our operation, the last year that we are forecasting here. Here you can see is the CAC. Very important to notice here is that our LTV to CAC ratio is 2.84:1. Now we acknowledge that this is less than 3:1, which is generally considered to be the market standard for good LTV to CAC. However, we have to understand that we are in a very saturated market and we are a new company, right? This is our 8th year of operation. So having achieved such a big number is a great achievement for us. Now, as you can notice here, we will now show you the definition of our hero product. You can see here that the absolute terms, the amount of EBITDA we make on one t-shirt is actually very less compared to that of a hoodie. However, we still identify t-shirts as a hero product. This is because t-shirts account for 60% of our revenue, while hoodies account for only 39% in the last year. Also, in terms of percentage, this is 47.6%, while hoodies is just 38.8%. Now, I would like to invite Anirudh Banga to continue.
Hi. So now we want to move to our balance sheet. So if you look at our balance sheet, firstly, I'd like to point out that we have used 2 simplifying assumptions in this sheet. Firstly, throughout the entire model, we have assumed no current liabilities, no prepaid assets, and no outstanding liabilities. And secondly, we have said that there are no debtors or accrued income. And now you might be wondering, why is this? Well, the reason is simple. This is a D2C pay and buy model. Now, I want to take your attention to the closing stock. So how we work on our inventory, in fact, is a very conservative production-led approach. So what we do is we do not assume full sellout in each time period. What we do instead is that our production is planned against our expected demand, and whatever portion remains unsold, we account for that in our production for the next year, which is essentially our closing stock. Now the way we calculate this, you can scroll a bit down. Yeah. The way we calculate this in the final value is we take our opening stock and our units produced and add them together. From that, we subtract the net units sold and the dead stock sold. This is multiplied with COGS to give us our output of 1.1 crore as our output stock for the last year.
Alright, now moving on to our expenses and cost projections, cost and profit projections. As you can see, in the 3rd year, we achieved profitability at a gross profit level. However, at a net profit level, we only achieve profitability in the 7th year. The reason for this is that we are investing heavily in building of a team and we're spending a lot of money in advertisement, because that is how you can grow in these markets. Now we're moving on to our cash flows and our DCFs. As you can notice here, our IRR is a very strong and attractive 28.3%. We would like to highlight that while we are calculating our DCF, we have taken a terminal value as an simple average of a terminal value using the Gordon's growth method and the exit value EBITDA multiple method. Yes.
Yeah. So this is our funding sheet. This is how we calculate how much money we need to begin operations. So if you look at it, in the early years, we have a system where at the end of each year, the model identifies the free cash flow deficit of that year. And what that does is it triggers requirements to raise that fund plus a 6-month operational runway to ensure that our business continues. If you can scroll a little bit down. Yeah. So how we've split our funding is we've taken a capital to bank loan ratio of 60 to 40%, which is progressively repaid through the years. Coming down to the loan that we have taken. coming back to the loan that we have taken, what I'd like to point out is that our model automatically calculates when to pay back the loan, and the way it does this is it checks our PAT and checks to see if this is greater than the loan amount for that year. The year that PAT grows larger than the loan amount, that is repaid. In the case of our model, that is FY34. Now I'd like to bring you to our revenue sheet. So for our revenue sheet, we followed a very bottom-up approach, and let me walk you through the numbers for the last year. So what we have done is, as you can see, our numbers grow from 2.1 lakhs to 31.3 lakhs. This is by assuming our growth rate for this period to be 45%. This is then added to our 2.2 conversion rate to give us 70,000 unique customers, and a 20% repeat rate on top of that gives us 84,000 orders for this year. Adding a modest 2.98 as our items per order value gives us a demand of 2.5 lakhs. Now what we do with this is we add the return rate on this over here, which gives us our gross sales of approximately 3.8 lakhs. Yeah, so one thing that I'd like to bring to your attention here is this hybrid matrix that we have made over here that shows basically the percentage of items sold discount wise. Now the way this works is it says that 60% of all our products are sold at no discount, 20% of them are sold at 20% discount, and etc, etc. Now this is important because we use this to calculate our average sales price over here. What we do is we check how much of discount are we putting on one value, how much of discount are we putting on the second value to calculate this average discount. We multiply that by the total demand, and therefore the YouTube AdSense that we generate is added to create our total revenue. The difference the difference between dead stock and closing stock is as follows. Closing stock is what we consider to be unsold but sellable inventory that is carried forward from the previous year to the next year. Dead stock is the inventory that fails to sell within the certain time period of the release of that intended fashion line and is later liquidated and sold at a clearance rate.
Now I will be taking you through another very important sheet of our model. This is our production capacity prediction. So we are using a SAM-based capacity modeling. What we do is, first from a revenue sheet, we are going to receive the quantities of each SKU that have to be produced in each year. Now on basis of industrial standards and research papers, we have figured out the standard allocated minutes of each SKU for 3 tasks: stitching, printing and ironing. Of course, for caps you're not taking ironing. For example, it takes us 8 minutes to stitch a single t-shirt. Now on basis of this, we're going to get the minutes of each labor and each equipment that we require. And one second, I'm really nervous today, sorry. While calculating this, we also account for normal and abnormal idle time of the labor and equipment by taking a 90% efficiency multiplier. Now, we're going to assume the amount of each minute, amount of minutes each asset and each labor is going to work annually. And hence, you're going to get the number of labor and equipment that we require. Into the capex depreciation once.
So this is the capex depreciation sheet. You can just have a quick look. Moving on to the direct cost, this is how we've calculated the costs for each sheet. And finally, we'd like to bring you to a Monte Carlo.
A Monte Carlo simulation, sir. So, of course, all the assumptions that we have made are all not going to survive if this business is made in reality. So how do we bring a reality check to our model? And the answer to that is our Monte Carlo simulation. In this simulation, we have run over 10,000 iterations on our base model. And we have came to certain key points. One thing I would like to raise here is that we have created a custom-made app through which we could figure this out. However, we were not allowed to present that here, so we have taken a screenshot of our model to present it here. We would scroll up. I would like to bring to your attention the IRR distribution here. I would also like to tell you that our mean IRR comes to 25%, and we have a 93.6% profitability. I mean, 93.6% chance that we will be profitable. That is in 9,360 of the simulations, over 10,000 simulations, we are achieving profitability at a PAT level by the last year. Here you can see is our revenue fan chart. Basically, this green line and see is the 95th percentile. It shows the best case scenario. This is a medium. This is our median, and this is our worst case scenario, a 5th percentile. Scrolling down, here you can see the variation that we had actually applied. On traffic, we had applied 25% shock. On conversion, 20, and on cost, 5%, and return variable, 20%. And this is a correlation chart that shows how much each of these variables will have impact on MOIC, MOIC, IRR, and EBITDA. Thank you. Now, I would like to open the floor to any questions that our judges may have.
Yes. Sir.
Thank you, sir.
I think D2C, I saw the Monte Carlo, great.
Thank you.
In your opinion, which are the top 2 or 3 things your model is most sensitive to?
Traffic that we get on our website is the most sensitive, basically.
Because what we do is the way it works is that depending on the number of traffic we apply a conversion rate. So if traffic suddenly reduces, like our website does not get that much publicity as anticipated, then the conversion rate also applies to a lesser amount, and therefore we get less customers. So that is the first one. Secondly, I would say is our conversion rate, because that also matters as how much the trust has built in the brand that people are willing to buy from it.
And actually, the second is this is our third, and the second is our return rate. That's considered as a silent killer for many D2C fast fashion businesses. Even if you can see at a MOIC, it had a negative 0.34 correlation. So it is another very silent killer for business. That is the second most important variable.
Return rate is great for D2C, but return rate is generally for the cash flow. Like finally, how much capital do you need
Yes.
in the business? Generally, the D2C business, the scenario analysis, if you do, your biggest thing will be customer acquisition. Conversion is great. Most D2C businesses spend a lot of money to acquire customers, and that can balloon over a period of time. And especially, I think your model also covered a lot of things. I think one of the things which you should also think about, currently we are only talking about your website and where you get the customers from. Majority of D2C business, unfortunately, that's not the majority of the businesses run on Amazon or Google.
So we are
That's
actually
the
a
biggest
D2C
cost.
business, so we can only run on a website.
Sorry?
We are D2C business, so we cannot run on e-commerce platform. We're supposed to run on a website only. That was one of the guidelines.
Okay. Yeah, but think about it. I think if the business needs to grow, I think about what other channels you might need to go over a period of
Yeah.
So
time
we're just like
outside of the website.
And
we're
even-
barely repaying our loans at the end of the year.
And sir, they
soon next year we will look into that.
And so actually Amazon and all those things, they take a lot of margin also. So we will become negative at a gross profit level also, and we're already
No,
raising so much
absolutely,
funds.
and that's why I'm saying, isn't it? Because then you need to think about in your business model, like how do you cover for those charges? Because
Alright, sir.
D2C businesses, again, as you absolutely rightly said, there is a big charge of these Amazons and everything, but does your business model
Okay, sir.
sustains to cover of
Plan
of
was to
those
expand in 10th into all those places, because now it's return profitable even a PAT level.
charges? Yeah, okay.
So we'll think about
And
that.
maybe just a last observation from me before
Yes.
sir has any questions. I think I saw your price of your t-shirts.
Yeah.
Over a period of time, I saw only an increase of around 10 to 15% over a 7-year or 8-year period. Great if you can maintain that, but I think about inflation also of all your cost of goods which go into 10% to me sounds a little bit low over a period of 8 years. You know, if you take about the general inflation in India is around 5 to 10% every year. Right? So again, when you're thinking about scenario analysis, think about how those small changes can impact the
Actually,
final.
so we had thought that we don't want to increase our price too much, because we are still a new brand, so we wanted to keep our price a little less only to build brand loyalty before and brand equity before we expand to increasing our prices.
So
Yeah,
plus we're in a very competitive market. Like
Yes.
we consider our competitors to be sold stores, like as a fast fashion brand, Beefcoof, Snitch. So in that context, if we try to match their pricing range, especially in the beginning few years, we won't be able to establish ourselves as an alternative.
Agree. Again,
But yes, sir, we will consider that.
Yeah.
Yes.
always have to maintain the two sides. To
Yes.
maintain where you get customers from at what price point versus your profitability and how much capital do you need, because that will go into how much capital do you need at any point of time.
Okay.
So absolutely
Thank you, sir.
agree. Not the easy answers to any of these questions.
you've really given us something to think about.
Great.
Thank you, sir.
First of all, compliments for wonderful work.
Thank you, sir.
Because I'm not seeing any difference in sitting in PGP class presentation and here, right? So, you have reached already to that level. So, only thing is that direct cost, whether you have considered some sensitivity of the direct cost, because
Yes,
the
sir.
raw
So in
material
Monte
and
Carlo, we
input
had
costs
done-
are
In Monte Carlo, we had done 5% variation on the cost of production, sir. And operating expenses in general, actually, not just production.
That's one thing. Second is you have done that Monte Carlo analysis.
Yes.
Whether you have done demand estimation for that one or just you, I'm seeing only the IRR part of it is.
What did you want to see, sir?
You, here,
Yes, sir.
yeah. This is the IRR you are looking.
Yes, the histogram is higher and the fan chart is a revenue chart, sir.
Acha, okay, here revenue chart
Yes,
is
sir.
there, fine. Why the bank can give that much of the debt for this venture? Why should you think that the debt is too high, that is more than 50%?
Sorry, sir?
Debt is how much now? Leverage you have made assumption.
So we've taken a 60 to 40 ratio. 60 has been put in by the founders and 40
No,
as a bank loan.
I think slightly more than that one. 60
So
is the
whenever
founder.
we are raising new funds, that is the ratio we are following. Of course, as the time progresses, it accumulates, and the ratio will be a bit different. However, we did not calculate a debt equity ratio because the equity was actually negative in the first few
Because
years.
not much of the machinery and all that one, and you don't have any current assets and all that. Why do bank finance that much of the money?
So that was a
Yeah.
simplifying assumption, basically.
Yeah,
like,
okay, fine,
yeah.
it's all right. Otherwise, everything is good. Right. Yeah, I'm not expecting the answers, just a comment, just suggestion. Yeah, thank you.
So we'll think about it.
Thank you, sir.
Thank you, sir.
ये खोलना होगा ना?
So the next team is Asmi and Ishan. They are from Bangalore itself.
Start? Good morning to each and everyone present here and our respectable judges. I am Asmi
And I'm Ishan.
and we have been teaching JEE and NEET aspirants from the past 7 years individually, one-on-one and in small groups. Over our entire course, we noticed two main issues. One was the high cost of students and the second one was low completion rates despite long study hours. So as we were thinking, could we make an EdTech company that was both scalable, profitable, and also gave students a chance to pursue their dreams without having to pay extra costs?
So we went from individual teaching to scalable edtech. So our main target audience is children from 9th to 12th grade, and we offer mainly courses of JEE and NEET. Over the course of time, we add shorter courses like AI, public speaking, financial literacy, programming, etc. to boost our revenue.
So before we get into the main Excel sheets and the financials of our plan, we would like to show you the key metrics upon which our entire business plan is pivoted.
As you can see in the charts, the revenue scales over 10x in 10 years. This is due to the growing student volume rather than increasing fee hiking. Student base scales steadily. It rises steadily. due to the launching of new courses over the course of the years. Also, we have made a course-wise revenue chart which shows how the revenue is distributed over various courses.
As you can see, JEE and NEET have been our main focus in these course-wise revenues, but our ancillary courses also provide us with a decent amount of revenue. And as you can see, we have our EBITDA margin growth. It is slightly low in the starting years due to upfront investments in our faculty and training. But it increases at a steady rate as the business grows and our debt is paid off and profit is accumulated. Our ARPU, which is our average revenue per user, which is our students, expands after the initial years as there is a higher retention of students, and we're including more courses, better quality content, and one-on-one sessions. Our LTV and CAC ratio improves as scale increases. This is because our LTV, as our company gains momentum, it will gain publicity and our cost of acquisition, which is our marketing, will go down and the retention of the students will be higher. Now, we would like to show you our assumptions.
Okay, so our assumptions are based on extensive research of competitors and real-life examples. So we'll start with the assumption tab because everything flows from here. Our assumptions are intentionally moderate so that we can get more students in our early years. On the demand side, we assume gradual increase in students every year as we release more courses. On pricing, we avoid sharp fee hikes, and for profit, we look more on increasing student volume rather than increasing fees.
This is our cash flow statement, which basically shows how the cash moves around in our entire business. So in our early years, our operating activities are in negative due to upfront investments in our teaching and infrastructure. So we've taken our operating activities as our PAT, which is our profit after tax, and the depreciation and amortization are added back as they are non-cash expenses. In our investing activities are basically our one-time fixed costs that we're putting into the business, which is mainly into tech infrastructure and our fixed costs, and they're added back periodically to improve our content and quality of our education rather than on repetitive cash flows. And then for our financing activities, we're taking them as our, so our main cash inflows in the beginning years are through VC funding, shareholders' equity, along with a loan taken from the bank.
Now let's move on to the P&L statement. The revenue section shows how our revenue grows over the years and how our business becomes profitable. The expense section explains how the money is being used, and it shows that we are not using heavy investments for growth, whereas we are using operational efficiency. The important point is that not early loss itself will affect the business, but there should be a clear path to profit, which is there in a model. EBITDA helps investors compare performance across the years and see whether the business itself is becoming more profitable. The unit economics section tells us how each student helps in affecting the profit and that growth won't cause losses. So overall, P&L is not just about profit and numbers. It tells the story of how the business grows, how the costs behave with scale, and how sustainability is achieved and if it can be expanded for the long term.
So this is our balance sheet, and as you can see, our total equity and liabilities matches our total assets. So for our shareholders' equity, me and Ishan both are going to be putting money into the business. We have taken our reserves and surplus as our profit after tax, and our total equity, and so our non-current liabilities are basically our loans which we are taking. And so for our assets, we have two types of assets, our non-current and current assets. So in our non-current, we're including our PPE, which is the property, plant and equipment, along with our intangible assets, which is basically our course materials along with the short videos that we will be giving the students. In our current assets, we are renting a small property for the shooting of the videos, along with our cash balance and balance at bank to show that there is a steady growth. although the numbers do go negative in the first few years, you can see that there is a steady growth, and we go positive as after our company starts to gain momentum. And so we'll show you our revenue projection now. You can see that our final revenue has pretty decent numbers. So basically in our company we'll be introducing two types of courses. One is materials only, and one is our complete course, which provides one-on-one mentoring, small scale mentoring sessions along with small videos and the materials. Thank you.
Yeah, Ashmi, hey Shan, great job, very, very confident, great. And great model. I think you guys were very thorough, especially on your cost projections and everything. Again, did you do some scenario analysis on the model overall? What's your sensitivity analysis on the model? What's your model most, what are the factors affecting the model the most?
So that's the key metrics and that we showed in the graphs. So those are the main things, key metrics that will affect how our business grows, and all of these are based off our assumptions. So if we change our assumptions, anything in the entire module can change.
So our model is sensitive to number of students who are coming in, and that is basically the amount we're charging them per course. So as long as the cost is relatively lower than other competitors and our content is good, then our business will do well.
Yeah, agree. I think both correct answers. I'm just saying in a model, you should also think about and actually do that analysis. And like if it changes by 5% or 10%, all those key metrics which you showed, because there's, as you rightly said, Ashmi, they're all based on assumptions, right?
Yeah.
And those assumptions can change, especially over a period of 7 to 8 years. Right? So do that analysis and saying, these EBITDA profit assumptions, do they still hold?
Okay.
And because if the market conditions change, on how much leeway do you have, because that will depend upon how much capital do you need at any point of time, isn't it? And how much buffer do you need on your capital at any point of time to do that sensitive analysis. So any of these financial modeling, that sensitivity analysis is a very, very important part of doing that model. Second thing, and again, I think you guys have thought about it, but especially in an EdTech business, the upfront fixed cost is very high. Because that's the way you have to make the whole material, and unlike, let's say, a D2C business or any other business, your upfront cost is very high in an EdTech business. And over a period of time, what you assume is that EdTech business, the marginal cost of getting a customer is much lower, because once you have the material, the marginal cost is very, very low to get a new customer. So how do you amortize that fixed cost over a period of time, and does your business is capital efficient over a period of time? So I think you guys have thought about it, but again, think when you do that sensitivity analysis, how does that depreciate? What's your marginal cost of getting a customer on that fixed cost, and how often do you need to upgrade on your materials and everything?
So that we've mentioned that in our, I think.
Yeah. So I saw that. And I think you had that year one you had a fixed cost, and I think year 2030 you again had a fixed cost, so which is great. But think about, because those are very, very important metrics for a EdTech business, right? So think a little bit more around those things, if those numbers are great, or if you need to make any adjustments to those numbers. But otherwise, great job.
Thanks.
Yeah, wonderful job. No doubt you have done excellent Excel exercise. I have only a couple of comments for. Why do you think that financial literacy and public speaking people will pay and join the courses? Because these are available very much on, so many free courses are available, and why do you think that they pay for financial literacy and will join, or for the public speaking they join like that? That is, I don't know, what is your view on that?
Sir, so let's take the example of Physics Wala. He does give free YouTube videos. But then people are still joining his company right now to take his courses. In the same way, we are giving these people better videos, better training, and all of that. And these are important life skills, so people will apply for it.
Okay. What is that unique content which could be different from other platforms, other companies?
we would
There's
provide.
a lot of competition in this market now, and there are failures also, right? So, what is that lesson you are getting? What is that unique content you are thinking to engage the student?
Sir,
And
yes.
yeah,
So the main issue with most edtech companies, like if you take Byju's for an example, the main issue with edtech companies is not that they don't have enough business. There's plenty of opportunities in the market because this is a very highly increasing sector right now. But the issue is that they get too ambitious too fast and they start investing a lot of money and they don't get the return from it that was expected. So that's why we've taken our assumptions to be very conservative and made sure that we have kept quite a lot, we have kept some leeway for us to pay back our
Controlled
loans.
investment we have done.
okay, right, thank you.
So our next team is Pulkit and Aryan.
Hello.
They're
Yeah.
actually from the same school but different branches. So Pulkit's come from the north part and Aryan is from background. Please welcome.
You go that side.
Stay here. Stay here.
Okay.
When you be able to stay.
Hello, mic check. Yeah.
Hello, hello.
So at 8 minutes, you just raise the hand and tell you guys at 8 minutes. So you know that you have to wind up in the next 2 minutes.
Okay. Yeah, we begin on a self count of 3, 2, 1.
Little clothes made with big imaginations. Good morning, respected judges and guests. I'm Arihant and this is my teammate Pulkit, and together we're Minikraft. India's kidswear market is one of the largest growing apparel sectors, expanding every year on 5 to 7% CAGR. Moving on to the business. So our business is focused on building an affordable premium kidswear brand, offering safe and comfortable stylish clothing for children of age 1 to 15. Then our market opportunity. So the growth is driven by rising disposable income. Basically, that means since people are making more money, that means they will want to spend more on this type of clothing. And parents today obviously prioritize the comfort, safety, and the designs, which again creates strong demand for these clothes. And since kids outgrow clothes quickly every 6 to 12 months, again, it creates recurring purchases and repeat purchases. And our SOM, so our realistic target is 2 to 4% of our SAM over 4 to 6 years. And moving on to our target customer. So our target customer is urban Indian parents aged 28 to 45 looking for reliable clothes for their children, then families belonging to middle and upper middle class. And then we have parents of kids 1 to 15 years, meaning covering toddlers, young children, and early teens. And then our product line, we have daily wear, seasonal wear, occasion wear, and everything is child-safe fabric, modern designs, and adjustable fittings. And finally, our sensitivity analysis. So our model includes strong sensitivity analysis on the AOV. That means even a small change in the AOV in the average order value will significantly affect the revenue and the profitability. And the model also has sensitivity analysis on the COGS, which result in a change on gross margin and cost efficiency. Moving on to the assumptions. So we can start with the average order value. We have the marketplace, the D2C, and the store. And we have an annual price increase of 3%. So our COGS are 44% of the revenue, and our packaging and material is 6% of the COGS. Now we have other factors in play here. We have logistics, storage, inventory, returns, marketing, salary and employee costs, rent, salaries, and miscellaneous and other expenses. Now we have our initial capital required, which is 1 crore, which is typical for the D2C launch, and an initial inventory cost of 15 lakhs. And our yearly tax rate is 25%. Moving on to Pulkit.
Now, moving on to the revenue and how we generate our revenue, it's based on three key points, being the e-commerce platform, our own website, and offline retail channel. Starting off with the online retail platform, we'll have an offline commission charge of 15%, which is normal for Amazon and Flipkart. And we have taken our MAU at the start at 10,000 of the online e-commerce, and we have taken it by 10, 15, 20% increase throughout the years. And we've taken a 1.5 average orders per month. And as you can see, on the own website, we have taken a higher average order value and a higher monthly orders per MAU. This is 1.6, 1.5. Reason being that people visiting our website or store would be willing to spend more. And in the offline retail channel, in the first 2 years, as our business was growing and we didn't have that much investment, from the third year, we started the pilot phase for 2 stores and up to 20 in the 10th year for maturity. Then our total revenue summary comes out to be the sum of all values, and this is the cumulative. This does not include any COGS or any costs. Now moving on to the cost projection. This includes our COGS, which is the 44% of our total revenue, and we have done packaging materials as 6% of the COGS, meaning 44%, 6% of 44% is for the packaging and materials. Now in the operating expenses, we have done warehousing, logistics, marketing and customer acquisition, and also operations and overhead. So in our warehousing and logistics, we mainly took care of inbound logistics, outbound logistics, and logistics pre-return if any products is returned by the customer. And also for the marketing and customer acquisition, we have taken an increased rate in the first 2 to 3 years, showing that we'll invest more in customer acquisition for the first year so that we gain the market. And also we have taken 6 and 4% constant throughout the years. Then operations and overhead include the salaries, office rent, utilities, tech and structure, and also the miscellaneous calculations. Now for the offline stores calculations for the costs, we have taken number of offline stores, rent and employee salaries. And then total OPEX comes to be 72.3%, and this is the input capital required for our machinery, which is 1 CR, and inventory cost is 0.51 CR. Now moving on to the P&L statement. This consists of our revenue, the revenue growth as percentage of 1357. As you can see in the third year, it's 57%. Reason being we opened our offline retail channel, so there's a hike there. And also, this is the COGS, and we have mentioned the various factors taken into consideration, being the warehousing and logistics, operations and overhead, and total OPEX being 72%. And here we've calculated our EBITDA, operating profit, depreciation, PBT, and PAT, which comes out to be negative in the first 2 years as minus 4.3 and minus 3.3, and from the third year our business becomes profitable. As cash flow from operations is same, and for the net working capital, we have done miscellaneous calculations which I will come back to later. So here I've calculated my cash from OPEX, which was 1 CR in the start, and now coming into the NPV and IRR. So at NPV, I've taken a 10% discounted rate throughout my years to keep a stable rate for any factors affecting it, and for the IRR, I've taken a 47%, which comes out to be my total internal rate of return. Now moving on to the miscellaneous calculations. This includes my depreciation calculations, which was done on the written down method, and this one is my working capital calculation, which is done on the trade receivables, inventory, and trade payables. So I summed my days sales outstanding and my inventory days outstanding and subtracted my payable outstanding to find out my net working capital, and I found out this value. Now moving on to the sensitivity analysis part. in the assumptions, a small change in the sensitivity, as you can see from the base value, for an example, if there's external factors affecting the business, such as recession in the country or less willingness of the customers to buy their product due to some external factors affecting it. Then a small change in the AOV. One example, if a hike in the AOV is there, if there is a 12% hike in the AOV, then in the key outputs and insights, you would see in the average sensitivity scenario, any other sensitivity will be affected here. And the basis is given here. This is static, meaning that nothing is changing. So this is a 5% increase, 10% negative AOV, and this is, we have done the sensitivity on the second parameter being the COGS, which is minus 10%, -5, base, and 5 and 10. So a change in the COGS from base of 44% of the revenue. For an example, if it reaches a different number like 52%, then in the key outputs and insights, you can see there is a change here. And if we increase the COGS even above that value, then for the first 2 years, our business even is negative. The cash flow of the business is even negative. So in conclusion, I would just like to say one thing, that at Minikraft, it's actually built not only on thoughtful design, but attention to details and aligns to customer needs, because kids deserve clothing with attention and high quality.
Thank you.
Yes, please.
It's a very highly first of all, I appreciate your work. So many Excel sheets designing these things, connecting each one. Your assumptions are also reasonably good. And but the market issue is the market is so competitive in this area. How do you address? How do you think that these assumptions holds good and growth rates and all that what you have made assumption?
Yeah, so as he mentioned, mainly we focusing, as first we analyze the market size. For an example, we got the market size, and what we're projecting as of now, because of the high competitiveness, from the SAM, we project to have like 1 to 3% achieved of the SAM as our SOM in the first 4 to 6 years. As a for a high margin business, it takes time to grow. So that would be one point I would take into consideration.
Great job, very well done. Two things and more observations. First, I think you guys should think about the inventory cost, because initially what I saw in your presentation, I think you had the amount of lines which you had, the SKUs you have is very, very large. At least that's what you are, like festive wears also, daily wears also.
Yeah.
And then your age group is very large. You are thinking about age 1 to 15. So if you multiply both of them together, you are talking about a huge number of SKUs. Right? And every additional SKU you will talk about in a D2C business increases your inventory cost, not
By
a
a great
marginal,
percent.
by a lot, isn't it?
Yeah.
And the problem with the D2C business is, if you promise something to the customer, you have spent so much CAG to bring the customer to your website, and if the customer comes there and doesn't find the product they are looking for, you are never getting the customer back, and all that CAG is down the road. So how do you balance those two things of saying, I have large number of SKUs, but with the CAG? So most businesses like this will start with small number of SKUs on day 0, and you focus on those SKUs, and then over a period of time you grow your SKUs as you establish your plan.
Yeah.
So that's one thing for you guys to think about. I think in terms of modeling, you guys have thought about majority of the things. Again, especially for a D2C business, the CAG is the most important thing, and especially when you're thinking about marketplaces. Also think about between your website and when you're talking about Amazon, Mantra, Flipkart, what is your conversion rate between those two things? How are they different? What do you need to do differently between those two different omni-channels to make sure that because your rates are different, you obviously want customers to come on your website as compared to Amazon because your cost is much higher. But then you can't have the same assumptions for both the things in terms of what CAG is required and how much money do you need to retain customers on those websites.
Yeah.
So currently, I think for the simplicity of the model, you have assumed
that
to be
10%.
same. But when you drill down into it, think about what do you need to do differently. How is your cost going to be different in those two things. But otherwise, great things. I think you guys have really thought through a lot of things. And very confident presentation. So great.
Thank you.
Hello, test.
Hello. So you can control it from here, right?
Oh, put on your pocket. Do you not have a pocket? Okay. Yeah, we can begin.
So good morning, everyone. And so before I start explaining to you all the numbers and all the finances part of it, I'd like a quick raise of hands of how many of here love chocolate. That's quite a lot. Now, you know, usually we don't give it a thought before we eat chocolate, but Finathon has, you know, made me realize that behind every wrapper is a complex business system of supply chains, manufacturing costs, and market positioning. So today we present to you the financial model for our chocolate brand, which is premium health chocolate brand. And so the chocolate market is currently split into two parts. One, which is the, you know, cheap mass producing market, candy. And the other one is the one where they are health conscious and they were willing to pay for extra quality. And that is the one that our business targets. So we sell fewer units but at a higher price point, and this strategy ensures better margins and lower risks than high volume competitors. Now let me walk you through the logic. So this is the description sheet. It serves as our strategic roadmap. Now our model is built on controlled production. We're not, you know, trying to flood the market, but we're matching the supply strictly to the demand to minimize waste. And you know, as you can see here, we've defined our product mix and our target demographic. By clarifying these constraints early, the rest of the financial model stays realistic. And we aren't guessing, we're planning based on the specific business identity. So moving to the sales projections, many startups make the mistake of predicting a hockey stick graph, you know, blast of sales overnight. We avoided that mistake. Right? So if you look at year 1 versus year 3, we've seen a steady growth, organic growth, and we've calculated this based on realistic monthly customer acquisition. Now this helps us in two ways. It prevents us from buying too much inventory, and it also ensures that we don't hire staff that we can't afford. And this sheet, you know, proves that the business is viable with conservative estimates and not just for best case scenarios. Now moving on, this brings us to the basis of calculation. Now this is the engine room for our model. So the accuracy depends on the assumptions. Here we've listed every variable. And for an example, let's look at the assumption for our raw material costs here. Now we've factored in inflation, and if the price of the cocoa rises, accordingly the sheet that feeds the data into every other sheet in the workbook. Now this makes our model dynamic and stress tested against the market changes. Now let's look at the result of those assumptions in our P&L statement. Now this sheet tracks our revenue minus our costs to find our profit. Now if you look at the bottom line, although the first year profit is in negative, we break even by the third year. And what's important here is our gross margin, because we're a premium brand and our gap between the cost of the ingredients and the selling price is healthy enough to cover our operating costs. And this proves that the high value strategy works. So here's the cash flow statement. Right, so profit is an opinion, but cash is a fact. You can be profitable on the P&L, but still go bankrupt if you have no cash in the bank. And this sheet tracks that timing. So it accounts for when we actually pay for our suppliers versus when customers pay for us. As you can see by the positive closing balance here, so we have sufficient liquidity to survive us the early stages. Now, next is our balance sheet. So the P&L showed you the performance over a year, but this sheet shows, you know, it gives a snapshot of your performance like at the moment. So it balances what we own assets against what we owe, right? And here our liabilities are managed responsibly accordingly, and this balance is really critical for investors as it shows that the company is solvent and it's safe to invest in. Over to Adrit.
Okay, thank you, Mahishka. So let me show you what goes into making one of our chocolate bars. Our contribution margin 1, which is the gross profit margin, throughout the 10 years is roughly 50 to 60%, which is an industry standard. To get this figure, we have accounted for all our variable costs like logistics, packaging, raw materials, etc. Furthermore, our relatively high fixed costs in year 0 are justified by the initial cost of setting up machinery and the manufacturing unit, and that would be the orange section on the pie chart. Moving on to some of our key performance indicators, the LTV CAC ratio is one of the most important figures in D2C businesses. This is because it's a measure of how effective our marketing is. However, in year 1 and 2, our customer acquisition cost is relatively high. This is because we are just building a name for ourselves. However, our LTV CAC ratio is expected to hit a good milestone of 3.7:1 in year 4. Moving on, in year 4, we expand into the European market with the Coffee Date Chocobar as our flagship product. This is followed by the Dry Fruit Chocobar in year 5. As you can see, once we launch, both the products in Europe, the average order value jumps from 400 in India to around 1400 in Europe. By manufacturing in India and selling in Europe, we exploit a huge currency arbitrage that, if you look at chart 3, has a significant increase in our PAT percentage in year 5. Okay, now since the market is not always going to be predictable, our model needs to operate to some degree with some degree of flexibility. Through the executive dashboard, we can test how the business will stand against challenges that might occur during the 10-year period. Currently, we're in the default scenario, but what if there's a sudden increase in the price of raw materials due to a supply shock? Okay, so as I increase the value of this from 7 to 10%, you can see the changes reflecting in the rest of our model. It reduces the year 10 cumulative cash flow by 23% if you draw attention to the right of the screen. Furthermore, our break-even point is pushed back by a year if you look at chart 3. Now, the price of raw materials is one of the biggest risks in our business because cocoa is not easily available in India and the price of it is very volatile. Now, what happens if our products don't sell as well as we expect them to? So we have modeled this in a low growth scenario, which causes the break-even point to get pushed back by a year, as you can see on chart 3. And if you look at chart 8, you will see that the cash flow from operations is in the negatives. Despite this, our net cash flow will still remain positive due to the 1.2 crore equity we plan on raising at the beginning of year 0. Furthermore, we can also strategically decide when to begin the expansion into Europe, with the model allowing us to choose to launch in Europe in year 3, 4, or 5. If we launch in year 3, If we launch in year 3, we are predicted to have slightly less PAT percentage and revenue in year 10, while on the other hand, the PAT percentage for year 3 alone shoots up. Now, if our expansion were to be delayed by a year, on the other hand, it will also have a significant impact as year 10 revenue drops by 20%. What if we facilitate a more rapid switch to selling on our own website rather than selling products through third-party apps? Ideally, the faster the
the faster the transfer, the better the profits. Because we can pay less commission fees, but we'd prefer to maintain a balanced transfer of 3% per year. Okay, to conclude, we have modeled a business that balances conservative sales projections, healthy profit margins, and sustainable cash flow. We believe that this model represents a financially viable and well-planned business. At the end of the day, this business works not because it sells more, but because it understands the number. So remember, the next time you open a bar of chocolate, just remember, no thinking before eating, just have fun. Thank you.
Your presentation is tempting to have a chocolate now, but okay. Very good, good assumptions and all that one. And very nicely you have prepared this sensitivity part of it, scenario analysis. Good, appreciate all this work. Market is so again very competitive and flooded with a lot of imported chocolates, right?
Yes, sir.
So how do your model will sustain with those things?
Okay, so our plan is, the idea behind our business is that in the domestic market, the only premium chocolates available are imported. So what we plan on doing is creating a local premium chocolate brand, which allows us to lower our prices, which is what is going to drive sales.
Years it will take to build a brand for chocolate.
Well, hopefully not long if it tastes too well. I mean, marketing is the key in the first few years, so we plan to work on that mainly.
Okay. Right, fine.
Thank you, Adrit. Thank you,
Mahesh.
Mashika. Yeah, sorry. Great presentation. Thank you. I love your ambition of selling chocolate to Europe. We have all grown up the other way around, but why Europe? Why did you guys choose Europe? Isn't that a very crowded market for chocolate, coffee bars from India?
I think that's the whole reason we chose Europe, because I think if we would really like to stand out in a way, and if we can dominate the Europe market, I think these are not the sales values that we would have, and I think we both know that. It would be a lot more higher. So the reason we also chose Europe is because it's much easier to expand into. So in terms of exporting and all of that, it's a much easier market to expand into.
Okay, I understand the cost side of it. I still have question marks around how easy, again, what Sir was saying, isn't it? A chocolate brand in Europe, isn't it? Europe is known for its chocolate. Making a brand in Europe can be much more difficult than what the numbers might show, isn't it? So again, think about it a little bit more. And is realistic in 4 years to have a brand to go and sell in Europe? Is that realistic from a model perspective? Yeah, maybe once you are fully established, and I think Indian market is big enough, the pie in India market is large enough for you to sustain in the first few years without thinking about the expansion, because expansion comes with its own challenges and own cost associated with it. Other thing which you guys should just think about, and especially with every D2C model, is the initial fixed cost. And I'm assuming you guys have assumed that you're going to set up your own factories on day 0. You might not want to do that on day 0 to have your own manufacturing, especially as you are building a brand, because in this market the brand is a lot more important. You might think about white labeling some of your products and outsourcing the manufacturing part, which a lot of D2C companies actually do across all products,
Right.
not only food, because especially food, chocolate, these kind of things, the marginal difference between products is not that high, isn't it? There are only 2 or 3 components. You can change the variation a little bit, but how much? Not. So think about white labeling in the first few years, and because that will reduce your cost substantially. And then over a period of time, once you have established a brand, once you have the market, once you have the product fit, you can think about your own manufacturing, because obviously that gives you a lot more flexibility, having your own manufacturing. So, but think about, again, that. I didn't see that much around your CAG across different models. I think you guys covered it, but maybe do a little bit more analysis on CAG and what different channels you are selling through, and what are the cost assumptions in those different channels. because
we
that's
have the
again.
channels in the with
Okay, I'm sure because I think you guys were talking about it at some point of time, but in terms of sensitivity and because that's the biggest cost for a D2C thing, isn't it? The CAG and your channel cost, because that's where most of the D2C businesses go wrong. So in your scenario analysis, just think a little bit more about that. But otherwise, yeah, great job.
Thank you so much for the feedback.
The next team is from Bombay, Netic and Akash, all the rest.
Thank you. Would you take a wild guess? What percentage of the Indian youth is financially illiterate? You may say 40%, 50%, 60 or 70 if you're overly pessimistic. But I don't think many people would estimate this number to be over 84%. That is the reason why Netic and I have decided to make our financial model on an EdTech company. EdTech is currently valued at $5 billion, and it's expected to grow at a CAGR of 15%. However, the AI and gamified niche that we intend to target is projected to grow at a staggering rate of over 35%. Netic, could you please go to the next sheet? Hence, the rudimentary basis of our model is going to be a gamified version of EdTech, which teaches future resilient skills to young learners, including artificial intelligence and financial literacy. We are going to have 4 preliminary sources of revenue because we have a freemium model. The first one, which is at the heart of our sheets, is the advertisements. The second one is a recurring subscription like Byju's, Netflix, etc. The third one is extensive courses. We seek to imbue a curiosity within learners, which would encourage them to delve deeper into any particular concept, which would generate a revenue for us. And the fourth one is school affiliation, because many schools attempt to integrate AI, financial literacy into their academic curriculum as extracurriculars, however, are unable to do so. Hence, to have a third party do this would be an enticing offer for them. Netic, could you please go over the revenue
Following the conservative approach to our model, we've taken 0.025% of our SAM, which is approximately 20,000, and our free to paid users at 8% that goes at a perpetual rate of its preceding values of the standardized interest benefit. Then we also understand because we can take our payments at the start of a month, we receive an interest benefit that is around the standardized interest benefit of this industry. Talking about advertisement, we understand that we are a new business, we're a startup, so brands may not be willing to post their ads on our website. That's why we have almost half of the industry CPI values that we offer them. Can you please go to the revenue projections?
Cost projections.
No, the key outputs and insights, please. Yeah. Scroll down. Yeah, no, that's it. For our revenue percentage breakup, we understand that most of our revenue come from advertisement because of our CPI, and we understand that advertisements grow on a linear scale to the user usage. So as users identify our website, go on it, learn new things, the advertisements give us a higher revenue. Can you please go to the cost projections? Operating costs mainly consist of our variable costs. Just scroll down to manpower. For our manpower quantity, we have taken it according to our website visitors. It's directly related to our website visitors. So as they increase, our manpower quantities also increase. This increases our manpower costs. For our marketing, till year 4, our business is in loss, but in year 5, we break even. This is when we exit out of our survival stage. We understand that our CAC to LTV ratios are now predictable, and we are in this business. So that is why in year 6, we almost increase our costs by 10 times. This is because to grow into our growth stage, and as an Indian, we love our drama, we love our Bollywood, and we really we build credibility of a brand by seeing them on billboards, by seeing a celebrity in our Tata Sky. So this is why we almost increase our influencer marketing from 40 lakhs to 4 crores. Can you please take over for the cash flow statement, Nakash?
All right. The cash inflows, because we converted into Excel, I don't know why this error is there. We can share the Google sheet where the values are exact. Now the cash flow is at the heart of our model. Over here you can see cash inflow excluding debt and equity. These two values total out, but they are showing hashtags for a reason unknown to me. The cash inflow excluding debt and equity is the amount of money we'll get from our business, and down you have the cash outflow excluding debt maintenance, which is how much is required to run our business. This is the amount. The discrepancy is what we're going to have to raise. Now, of course, understanding the fact that we're a new model and we're a startup, it would be difficult for financiers to give us a high amount of debt. That's why we've taken a debt to equity ratio of 9:1, equity to debt ratio of 9:1, which means 90% of our funding is based out of equity and only 10% comes from debt. Our debt, we have considered an inherent circularity. We have taken a 22% increase in what our cost is required. For example, if I need 1 crore of debt, I'll take about 1 crore and 22 lakhs. So that 20 lakhs, when it goes into paying the 10% interest rates amortized over a period of 10 years, I still have 2 lakhs rupees, which is put in as a plug-in value in the miscellaneous cost to balance out the entire model. Now going on, Netic, can you please scroll down? Investment value over here. Investment value is going to be the discrepancy between the two. In the first year, it's about 3.5 crores, followed by 2 crores and 1 crore. Overall, throughout the life of our investment, this value totals to about 11 crore rupees. We have an IRR of 41%, and our valuation for the business is considered to be an average revenue multiple calculated through 6 different listed companies, which comes out to about 9 times. We've taken a discounted valuation because we understand the fact that if we have a recursive investor, in the case of Zomato and Byju's and Swiggy, which was present, they would want to have a discounted valuation as they recursively invest. So rather than asking them for an increased amount which is greater than what is our requirement, we would give them the option to continue investing the next year so that they know that their money is not getting wasted and we aren't spending more than how much we need to spend. Netic, can you please take over the market value table in P&L?
Yeah. So to get accurate valuations for our equity value, we've taken 6 listed companies. From screener, we've gotten the market and debt and cash, we've gotten the enterprise value. And accordingly, after taking the median, we've calculated a revenue multiple, our EBITDA multiple, and our earnings multiple. Can you please go to the P&L statement?
Okay.
Scroll
Can you
down.
please show our Google sheet, because over here.
Can you just scroll down, Nakash?
Enable editing and see if that will
There.
No, the hashtags are coming. That was not there in. Okay. Thank you so much.
Scroll down, Akash. This is our revenue, COGS, all our direct costs, expenses. For a tax, we've taken 15% tax, then we've added a 7% surcharge. Getting their total, we've added a 4% health and education cess to calculate our taxes. Come to the sensitivity analysis. Also, I would like to mention that we've taken a hockey stick model for our business, and we understand that at the start of the period, our growth will be slow, but in edtechs, the first 5 periods is a long gestation, but after that, it's just rapid growth.
All right, this is our sensitivity analysis. 2 of our most sensitive variables. First one is the amount of visitors we get in the first year. For this, our current value is taken as 20,000. This is the value in thousands. So 20,000, you get about a 42% IRR. However, when we decrease this to 10,000, it goes to about 27%. Versus if we get, let's say, 40,000, we get a 51% IRR. Our advertisement revenue is how much of, because advertisement is our preliminary source of revenue, what percentage are we getting compared to our current values? So 1 is what we currently get. You got a 41 to 42%. It's a randomized value, so it's rounded off. If we get only 20% of that, it will still be sustainable at only 14%. Versus if we get 1.2 times of what we're currently getting, we have an IRR of 43%. Netic, could you please go to miscellaneous costs?
Sure.
The miscellaneous calcs, we only have our depreciation. It's an asset light model. So employee onboarding is how much money we have to spend to get employees on board, in the sense we need to buy computers for them, systems for them. And initial device and hardware costs is how much we're spending on the initial purchase. We've taken a 40%, which is in compliance with the Income Tax Act of India, and we've taken a written down value depreciation. Now the key outputs and insights, please.
Yeah.
Go ahead.
This is our total revenue percentage breakup, as I talked about it. User metrics. Please come to the CAC calculation. Yeah. This represents a hyperbolic efficiency graph where you can see in the initial years our CAC is just going down, but in year 6, as we increase our marketing spend, our CAC shoots up, but then still continues to go down. Cash flow metrics, I think we'd, yeah. Would you like to take over? Yeah.
All right. Do you have any questions?
It's in time. It's in time.
Hey guys,
Hi.
great job. Good. Two questions. On your revenue stream, I didn't understand why are you guys focusing on advertisement so much? Like it seems to me like you're 60% or 65% of your revenue coming from advertisement.
Because we have a freemium model. In India, not many people have a free to paid user conversion. It's only at 8%. So most of our free users, they'll be watching about 30 seconds of advertisements on the app, and that is how we'll be getting our revenue. Because to a cost sensitive consumer where your cost is king, it wouldn't be lucrative for us to ask them initially for, let's say, 200 rupee a month subscription. Rather, they can see ads, and if they're really liking the platform, then they could switch to 200 rupee a month subscription, but they're not seeing any ads.
And for the free users, sir, I would like to add, they're also shown videos, and videos hold a high CPI value. That's what gives us the high advertisement as well.
Is that in line with the other edtech players in the market?
Okay,
right now?
so the edtech cost per impression, which is how much money you get for 1,000 plays, we've taken it as half of what the industry average is. Considering we're a nascent firm and many advertisers would be apprehensive to marketing on our site, we would provide them with a lucrative offer which would make this potentially a good investment for them. So it's exactly half. Around 6,000 is what others take, like let's say on YouTube and etc.
Per view per minute.
And for banners, they take about 50, but we've taken 25.
Okay, cool. Second question around CAG. Like your CAG graph, from day 0 to like year 6, you have assumed a reduced CAG.
Decreasing CAC, and then in year 6 we have bigger investments, so the CAC increases and then it constantly decreases. It's a standard hyperbolic depreciation on the CAC.
But why have you assumed a depreciating CAG?
Because initially we have a very setup cost. Additionally, a business will of course optimize over a period of time. In the first year, if I have let's say 100 employees and I have 10,000 people on my site, and the next year if I have 20,000 people, doesn't mean I'll need 200 employees. Maybe I'll only need 140 employees. So that you're going to have an optimization coefficient in your model, where you're going to have an increasing efficiency in your model, which will decrease the CAC, until of course when we 10x our marketing spending and we have big investments to revitalize our hockey stick growth, that it increases and then again starts to decrease.
Also in the industry, in the edtech industry, the retention rates are quite high. People want to learn about the courses. So we don't have to spend as much to get the new customers because the word spreads.
But in the first, at least in the first beginning few years of the edtech starter, CAC should go up because you're a very new brand, and especially with your model of even free courses and everything.
Free courses.
And CAG is not dependent on how much you're spending or number of employees. That's your cost of goods.
Yeah.
That's your fixed cost. How much you need to pay to build up your content. Your CAG is just what you're getting to get the customers. So I think on first few years you will need to do a lot more advertisement, a lot more.
Yes.
And then over a period of time, as you're rightly saying, the word of mouth will increase.
Okay.
So your CAC should come down. But yeah, so think about that assumption.
We'll
that
surely look into it.
Of course.
Yes. Zero does your CAC goes up? Because I think what you guys have assumed, I'm thinking the fixed cost is obviously very high in a tech, especially in your model.
Asset-light model.
Build up the courses. So your fixed cost is very high. But I think you have taken it here, but your CAG is also very high in the first 4-5 years. And then over a period of time, it might come down as you establish yourself.
Okay, thank you.
Yeah, excellent presentation. Why do you think this market will grow in a linear way?
In a linear
Because there could be disruption and there may be completely a model may change from this current way of
in a
learning
linear
to
way in the
a
sense.
new one. Huh?
In a linear way in the sense, the CAGR.
Yeah.
Okay.
It's an estimated CAGR through various analytical perspectives. It's not what we have calculated, but what we have taken from sources on the internet for the CAGR for the industry.
Why do you think the people will pay for premium for this one when so much of content is already available and a lot of products are there? As you
That's why
have shown?
we've only considered that 8% of the people will be paying premium, right? And on top of that, 8% of the people are paying premium 1. 2, we are only getting 0.025% of our serviceable addressable market. This market currently, what we're looking at, K-12, stands at 8 crore people. We're only assuming 20% to come on board, or 20,000 to come on board, which is 0.025, and then 8% of that is what we're expecting will take a premium subscription, which comes to
Even we've shown it in our sensitivity analysis how with our differing website visitors, we can have different IRRs as well. So for 20,000.
Netic, can you show the sensitivity analysis?
Yeah,
please?
1 second.
How do you?
Yeah, so actually it depends on the website visitors. It is one of our key drivers of the model. The IRR hugely depends on our website visitors, because even our manpower is connected to that. No, because if we have a high website visitor count, then we need more staff to work on it. You know, customer service, etc. That is why.
So what are the lessons you are getting from the failed educational tech companies?
Lesson. The lesson that we're getting from the failed educational tech companies, of course, the prime example would be Byju's. That would be overshooting a model, because although they had a lifespan of only 8 to 9 years initially, they became quite prominent. But that was all on the figment of debt. It is about creating a sustainable model. Over here in our last year, how many visitors do we have in the last year?
It's really low. Like, it's really low.
I think it's 5 lakh or something?
Yeah, it's around 4 to 5.
Versus if you're aiming at getting maybe 20 lakh, 40 lakh, the kind of advertisement spending that you're going to have, because Byju's had gotten Shah Rukh Khan on their billboards. They had gotten their logos on IPL teams. If your entire market is an illusion just on the basis of your spendings, then eventually you're going to burst, right? That was, I think, the first one, because initially we had projected very high costs, but then we realized that simply wouldn't be sustainable.
And as I said, so EdTechs usually in the start, first 5 periods, there's a long gestation period, then there's a rapid growth. And I feel like companies really get overconfident with their rapid growth and they invest more. But you have to understand, you have to start being sustainable. Your growth should be sustainable as your company matures. So that's what I think other EdTech companies
And that's why we have also gotten a terminal value only after our 10th year.
Yeah. You want to show me that?
From me, I
yes.
I forgot. I think in terms of your target market, you talked about 3 distinct things. First was your free paid views, which gets advertised. The second one is the premium, the people who take their subscription and then go through that whole journey of an AI course or what. And the third one was the schools.
Yeah.
3 of them all very, very different.
Yes.
Require very different kind of content.
Yes.
Also, because in the free model you're talking about very short 2 minutes videos, 5 minute videos.
Yes.
Second one, you have to make the whole model, and the third, school, completely different ball game altogether.
We even have extensive courses.
Yeah. So, but 3 different target markets.
Yes.
Isn't it? So think about again on day 0, do you really want to delve into all 3? Because again, brings up your cost. I think I really like the school idea because that's a big need.
We even offer them a discounted price so that we can encourage the schools to.
So the schools, it wouldn't be in the sense that we're getting the entire school. It would be like, let's say you have a classroom. Okay, if you want from grade 1 to 5 and there's 500 students, then we would give you a discounted price, which the school would bear the cost, so that your students can basically just get a premium subscription on our website. So over there they're getting like a 40% discount.
They tie up with schools and to run the AI course for them and all. Great idea. But think about again 3 very different target markets, isn't it?
Yes.
The way that you need to course and what it does to your fixed cost and also your marketing and everything else. And which one do you want to focus on? Which brings you the money in a longer period?
Of course. I think school affiliation would be the one to go because it's like 1% of our revenue.
But otherwise, great.
Thank you so much.
Thank you so much.
Let's walk.
Inventure Academy, Nakul and Rohan. All the best.
Thank you.
Hi, I'm Nakul Srinivas.
And I'm Rohan Rajiv.
And we are from Inventure Academy.
So this is our financial model for a D2C shoe business over a period of 10 years.
So as you can see, this is the projection sheet. It is the anchor to our entire model. So I would like to direct... All right. I would like to direct the audience to look at the numbers in year one, the beginning of our survival phase and the start of our venture. year 6 and year 7, which is during our expansion phase, and year 10, which is the end of this particular model. So as you can see in year 1, our costs are 140% of our revenue. This results in a negative profit after tax. This continues for about 4 years until we break even and are profitable in year 5. You can also see that we've done a terminal value calculation using the DCF method. We've taken a discount rate of 12%, as the CAGR for the shoe industry in India is 10%. You can also see our market share calculations. So our
Can you just give a brief what company you guys are setting?
shoe, it's a shoe company.
It's a shoe company.
D2C shoe company, yeah.
Manufacturing company.
Okay. Yeah, so our shoes are sold between 2,000 to 6,000 rupees, putting us in the mid-market segment. So as you can see, these are the total shoes sold in India in a year. And so we've assumed that the mid-market segment is about 35% of that. So that is our addressable market. And using our shoes sold in year 10, that represents a 1% share in the market. We've also calculated our IRR using our negative cash flows before financing. And our key equity insights, it shows our cumulative equity infused in the business, the value of the equity that it becomes with a 12% interest rate if you put it in the market, which is about 2x return by the end of year 10, and the multiple on that invested capital if you invested in the business, and what that external stake represents, which is about 7x. So the opportunity cost of not investing in the business is quite high, as you can see. You can also see in the equity calculations, it shows all this. It shows our total debt, our debt to equity ratio, and it shows that the founder's stake in the business is about 75% at the end of this model.
So for our model, we've used two methods of valuation, one being a multiplier on our revenue. It starts at 8x for the first few years, as we're a startup business and we have high growth potential. It goes down to 5x and then 3x at the end as we're matured and we're more established in the market. Now, the other method of valuation we've used is known as the first Chicago method, which is popularized for startups and new businesses. So how it works is you take our exit year, in this case being year 10, and you take our revenue in each of these scenarios, being the worst, base, and best case, which we'll get to later. You take our EBITDA at our exit year, and a multiplier, which we've selected at 10, 12, and 15x respectively. You take our exit valuation, and then we assign probability weights to each of these scenarios. We've said our base case is 60%, and as it's the most likely, followed by 25% for our worst case and 15% for our best case. Using a discount factor of 0.1625, we find our present value of exit, as is multiplied by our exit value. This is then weighed against the probabilities that we've stated, giving us our weighted present value. All of these are added to give us our final valuation for this method. Now we're going to move on to our sensitivity analysis.
Yeah, so as he mentioned, so we have 3 scenarios. We have a base case, a downside, and an upside, and we've created a scenario selector. So for example, these are our most sensitive and volatile inputs. They include revenue growth, our production growth, our price index, our accounts receivable days, our CAC percentage growth, and our interest rate. So if you make it the downside case, for example, enter 2. Okay, yeah. So all these numbers will decrease, and this impacts our valuation, as you can see at year 10. And then if you go to the sensitivity analysis, this translates to different sensitivity outputs. It changes the revenue, it changes the PAT, it changes our first profitable year and our minimum cash balance. Our minimum cash balance is always going to be 0, which we will talk about when we get to the statements.
So this is our statements page. It's comprised of 3 main components: our profit and loss, our cash flows, and our balance sheet. So in our profit and loss, we've included our revenue, our variable costs, our operating costs, interest, taxes in corporate and property. So in our variable costs, we've included things such as discounts and offers given, marketplace fees, cost of goods and services, cost of goods sold, and marketing costs. So you'll see here we also have our interest paid on both our loans, which happens in years 1 and 7 respectively, and our corporate and property taxes, which all leads us to our profit after tax. Now this is our cash flow, which...
Yeah, so getting to our cash flow statement. So basically the reason why our minimum closing cash balance is always going to be 0 is because if our cash flow before financing is negative, whatever that negative number is, and of course after subtracting the debt raised and adding the loan principal repayment, that is the exact amount of equity that we infuse to offset that minimum cash balance. And we do this as far and as long as our cash flow before financing is negative. And here, if you get to the our balance sheets, you'll see that our fixed assets we've excluded land, and this is because while our factories depreciate, the factory that we purchased, the land that it sits on, it actually appreciates, and we've purchased that land as well. So on our asset side, we have the appreciated land value, and on our equity side, we have our revaluation reserve, the cumulative revaluation reserve, which is the appreciation value, and this results in the balance sheet balancing.
So these are our production projections. We started with an estimate of 20,000 shoes produced in, oh, sorry. We just need to revert this back to year 1. Right. So we started with an estimate of 20,000 shoes produced in year 1. And you'll see in year 7, we have a significant spike in production, going from 153,000 to 175,000. This is because we've purchased our factory in year 7. So the reason for this spike is our factory is worth 1.625 crores and our machinery is worth 1 crore, which that can produce an estimate of around 150,000 shoes. So in year 6, we've hit this goal, which is why we need another factory to expand our productions. The reason we don't have a purchase of a third factory is because in year 10, we've not yet hit the cap for our second factory. And you'll see we have months of inventory at the bottom here. So for a shoe business to survive and keep up with spikes in demand, it needs to have at least 1 to 3 months worth of inventory for the next year's productions. So these are our cost productions. You'll see our cost of production per pair falls as the years go on. This is because we've included an economies of scale formula, where every 30% our production rises, our average cost of production goes down by 5%. This happens until we hit a limit of 25% of our original costs. This is because we felt it would be unrealistic for our costs to continually go down to even negligible numbers.
And you'll also see that we've accounted for inflation in every year. So our costs, they are also multiplied with the inflation multiplier, which is included in our description sheet, which we'll get to. And you'll also see that our CAC and our R&D costs are the highest. They start off as 50% of revenue, and then they slowly grow, and they're also included in the sensitivity analysis, and they slowly grow alongside the revenue growth rate. And you'll also see that under our fixed costs, so as per the newest Indian labor code, the employer contribution and benefits has to be 25% of the salary. So this is added to calculate our total cost, which is then fed into the statements. Now if you get to our miscellaneous calculations, you'll see that for depreciation, we've used a straight line method. So our useful life for our factory is 25 years, and for machinery is 15 years. And so the depreciation value is also is fed into the statements. For our tax calculations, we use the BBMP code. So this is a complicated formula that required the property square footage, which we calculated using the property value divided by the land value, to calculate the square feet. And so we calculate the total tax using the months, the cess, and this tax, total property tax, is also fed into the statements. The terminal value I already spoke about, and in our working capital calculations, we also have the cost of goods to produce the inventory, the ones that are not sold, and this is added to calculate the net working capital.
So this is our capital purchases sheet. It's there for both of our factories. On the right, you'll see our factory depreciation, and if we zoom out, you'll see our our land appreciation. We have an amortization table that shows our loan repayment in terms of principal and interest paid, and this is there for both of our factories.
And basically there's also a description sheet which just explains what the cost of our different shoes sold and our inflation multiplier. And so basically to sum it up, we have divided this 10-year model into 3 periods. One is the survival phase, one is the expansion phase, and one is the phase where we slowly become a more mature business. We've also taken the most sensitive inputs, and we created 3 scenarios where they change, and which translates to different outputs based on each scenario.
So again, this is our inflation multiplier, which is involved in every single cost we make as the years go on. Thank you.
Yeah, thank you.
Yeah, wonderful presentation. So many sheets and a lot of analysis. Appreciate your methods of selecting normal valuation DCF as well as first Chicago method and all these things. Good. How do you build the brand in this business? Because largely this shoe market is with brand oriented.
So the shoe market is crowded, but it's not oversaturated. We see companies like Comet and Neiman's, who are newly established in the market, have still been able to grow significantly because the Indian market is ever expanding, especially in terms of health and fitness. So
so our unique selling point for this and how we will build a brand is, one, we are a brand that is, we're more like we're a premium D2C company, but we're more affordable as compared to Nike and Adidas, as like their prices have skyrocketed in the past few years. And also we are a more digital focused brand, so we have no retail stores, and we're also going to be leveraging like the new digital landscape of India to do so.
We're catering towards the younger aspects of India, the people.
I have one issue with this land revaluation you have taken. Is it possible that land revaluation is allowed?
Sorry?
Land revaluation you have taken and appreciation is taken, right?
Yeah.
Yeah.
So we excluded it from the fixed assets because the land value is also appreciating. So we're putting the appreciated value of the land on our asset side.
No, is it acceptable, appreciated value of the land, putting it on the asset side of the balance sheet?
I mean, that's what the land like is worth like every year.
Okay. 18% interest rate, is it not too high?
That's the interest rate that's set by
for
government laws.
businesses.
For businesses.
That's set
it's
by
at
the
18%.
Yeah. Okay. Right. Very good.
Thank you, Nakul. Thank you, Rohan. Very good presentation, very confident. Two questions. Day zero, like any particular reason you guys have thought about using debt also, including the equity in the business?
So basically, like we only take our loans for collateralized assets, only for our land and for our factory, because we want to keep a low debt to equity ratio, and we want to keep our business low, a low risk. So we infuse equity for the other things, and so our cash flow is always going to be zero, the closing cash balance at the end.
But why will on day zero somebody will give you debt to buy land?
That's the loan that we're taking for the factory.
Okay, but think, because like on day zero, if you take debt, like especially for a fledgling business, a new business, that's a constant outflow from a business. So think about if it's better to take equity on first few years and then go down the debt route, because debt is a constant outflow on new businesses. Secondly, I think you guys are talking about a health brand and a premium brand. But to Sir's question, I think about what's your USP, very specific USP and the target audience, isn't it? Because right now I didn't see, at least, are you targeting like proper athletes at age group 20-30? Is your target audience teenagers, children, women? Because you can't serve everybody at that price range being premium, and the wider the segment you try to serve, the wider the SKUs.
Yeah, to answer that question, so our target audience is like 18 to 30-year-olds in tier 1 and tier 2 cities. Yeah, and like people who aspire to be like athletes, and like who are like inspired by different digital creators.
Okay, yeah, so then make that clear, that that's my target audience, and then what's the need of those target audience, and then think about how do you brand a brand for those particular target audience, and what needs to differentiate.
Yeah.
Like some of the brands you talked about, like Neiman. So Neiman talks about environment friendly, isn't it? That their USP along with the design. So think about what do you stand for. So
and just one more thing, because like our brand is targeting like younger people, 18 to 30-year-olds, and in tier 1, tier 2 cities, like that's why our CAC like is so high, like 50%, because we're like spending all on marketing, especially in the first year, on social media to leverage that and to like reach out to all these like younger people.
Yeah, absolutely. I think D2C brand, the CAC is the one which hits you in the first few years, and how do you, and over a period of time, but how do you reduce your CAC and become more capital efficient?
Yeah.
And I think you guys showed that on the cost, becoming more capital efficient as your size is growing.
Yeah.
Hopefully your CAC also comes down as you establish the business, and that's a sweet spot you need to find in a business. But great modeling. I think you guys thought about a lot of things, and very great presentations.
Thank you.
Thank you, sir.
So next team is very special team. It's two sisters who are twins. They're from Bombay. Please welcome Sunera and Niharika. All the best.
Like this. Can I just fold this? I don't have a pocket. Okay. Okay, so before we begin, quick question. How many of you think that kids' clothes are bought more frequently than adults' clothes? Can we have a show of hands? Okay. That is the correct answer. They are, and that's why we modeled this category. I'm Sunehra, this is Niharika. Here's what we learned building this model. How you actually get to a 21% IRR is by letting year one lose 6 crores. Now this sounds insane. Every instinct in finance says minimize your losses and reach profitability early. Well, we did the exact opposite. Our losses went from 5.8 crores in year 1 to 6.5 crores in year 3, which is 25 crores burned before we even generate the first rupee of profit. And yet, our model still produces a 21.6% IRR on 23 crores of invested equity. Now, this only looks contradictory if you assume early profitability is the goal.
Just can you give the brief of what is the business? I missed it. Sorry.
Yeah.
Kids
so-
wear. Okay, all right. Fine. Sorry.
Right. So these figures only look contradictory if you assume that early profitability is our goal. We didn't build this model to make the numbers look attractive. We built it as an intellectual exercise of the highest order to push financial modeling to its very limits. At its core, our model represents a digitally distributed kids apparel business. We have limited SKUs, outsourced manufacturing, and a hybrid D2C marketplace sales structure. Rather than modeling the company as a traditional fashion retailer, weighed down by excess inventory and complex capital-intensive supply chains, our financial model is intentionally structured to remain lean from day one. Now, this choice directly shapes the cost of our base, cash flow profile, as well as our risk exposure of the business. Our manufacturing is modeled as fully outsourced to specialized third-party partners, which is a deliberate strategic assumption we have made rather than a simplification. Because by excluding owned production assets, the model avoids heavy upfront capital expenditure and ongoing depreciation as well. As a result, our management resources are concentrated on higher value drives and brand development and customer acquisition, which is very important for our company as we started with low brand awareness. This modeling choice strengthens our margins over time, as well as supports a more reliable financial trajectory. So to make things even better, we wanted to identify the set of conditions under which our model could pull itself sharply out of our sustained losses and into a point where it not only reaches break even, but reaches a point where it ultimately produces again. A 21.6 IRR as a mathematical outcome. Now, how does this happen? Now, given the structure, the cleanest way to see whether the system is actually working is EBITDA, because that's where pricing, commissions, fixed costs, and scale all meet. In the early years, EBITDA is deliberately negative, as you can see. It's around -6% in year 1 and 2, which tells us exactly what we want to know. The model is absorbing marketplace and customer acquisition costs before scale kicks in. By around year 4, EBITDA is brushing break even, and by year 10, it's north of 50%. Once EBITDA turns, the operating structure starts funding itself, and everything from cash flow to deleveraging follows mechanically. Now, there's really only one remaining question, and that's, does the timing of these cash flows justify the capital we've put in? And that's where NPV comes in. Across the model, shareholders invest a total of 230 million rupees over the first 3 years. That's the period where losses are highest and EBITDA is still negative. During this phase, we also allow for controlled debt to span the bridge between scale up and EBITDA break even.
This smooths working capital and then unwinds quickly once EBITDA turns positive. Now, after accounting for both the early equity infusions and the temporary use of debt, the model generates an NPV of 200.3 million rupees. So the NPV is effectively proof that this structure works. The 21.6% IRR is the mathematical consequence of that sequence. Now, here's what this looks like on the P&L. Year 1 through year 5, we're showing a negative profit after tax law. We have losses of 5.8 rupees crores, 6.7 crore rupees, and 6.5 crore rupees respectively. But by year 6, it flips positive, and by year 10, we're generating 27% profit after tax margins in net profit. On the balance sheet side, these early losses accumulate as negative earnings through year 5. But once profit after tax turns positive in year 6, retained earnings start rebuilding, and by year 10, the balance sheet shows the exact amount of growth in accumulated earnings, as you can see. This is proof that the business has recovered from its loss years and it is now self-sustaining. All right, to sum it up, our model is actually asking if we deliberately allow our losses early, we push EBITDA negative, we tolerate our commission drag, and we accept brutal COGS. So when exactly does our system begin to self-correct? We're asking not eventually, but precisely when. And today we'll give you the answer to 3 very clear inflection points where a single variable transfers our entire trajectory of the model. Now, most people assume that COGS is a constant percentage of revenue from day 1. For example, let's say 60%, even when you're starting from 0. Now, we thought that was misleading because in reality, year 1 looks a lot more like this. We spend 3 rupees to make 1 rupee in revenue, and COGS is 295% of the net sales. Now, we made this decision because we know that the leverage a startup with 10,000 units actually has when negotiating with fabric suppliers is 0. Suppliers say, pay cash upfront, no credit terms, take it or leave it. But practically, the supplier dynamic has to mathematically flip at some volume threshold. So let's take a look at this now. We deliberately restricted our business to 20 SKUs at launch. A broad catalog would have spread those 10,000 units across dozens of designs, fragmenting volumes and increasing per SKU batch cost. Instead, with a tight SKU set, what we did is, each design runs at a higher volume and it accelerates cost efficiency. So by year 3, at 79,000 units, COGS has dropped to 107% of revenue. So we're still losing money, but we're stopped losing money per unit. Our suppliers start negotiating. And by year 10, at 1.6 million units, we're their largest customer. So how long must a business survive structurally impossible unit economics before volume drives procurement efficiency? Our model is very clear. It says year 3, 79,000 units. Now, when we got to the channel economics section, we wanted to model a mechanistic way that customers would actually migrate from one channel to another. Because it didn't make sense to us to just assume we would stay 90% dependent on marketplaces forever, or just assume that customers would magically flock to our website and drop our commissions to 0. So in year 1, 90% of the sales come through marketplaces and 10% come from our website. Because if brand awareness is 0 in year 1, then where customers will actually find you is marketplaces like Amazon and Myntra, not your own website. Now, the decision was to treat marketplaces explicitly as customer acquisition infrastructure and not as permanent distribution partners. Now, once that assumption is applied, our channel mix begins to shift mechanically, as you can see. D2C shares rises to 30% and finally 55% in year 10, and marketplace share falls to 70% and 45% respectively. We are assuming a ceiling of DTC penetration because some customers will always encounter the brand first on Amazon or Myntra. So it's not realistic to assume full migration to the website. Inflection 2 therefore occurs in year 5 when repeat customer cohorts become large enough for the channel mix to shift decisively and commission costs fall below the level where they cease to dominate unit economics. Now, the question isn't when does this business break even, but how easily can that answer break? Because a single break-even year is meaningless if it collapses the moment one assumption moves. So we built a sensitivity analysis testing 3 critical variables out of all of the macro assumptions you saw underlying the model in this sheet. Now, we started with working capital. We asked what if we're wrong about how long inventory days sits. Maybe instead of 60 days, it becomes 80 days. Because kids apparel does move fast, but what if it doesn't? So we modeled inventory days ranging from 40 days to 90 days, and we combined that with receivable days ranging from 3 days to 15 days. And as you can see, IRR ranges from 17.7% to 23.2%. Even at 90 days inventory and 15 days receivables, which is effectively the worst case scenario, we still get a 17.7% IRR. So the model still works. Now, if you look at the same variables through NPV, it ranges from 15.4 crore rupees to 22.8 crore rupees. Next, we assumed we priced 15% below competitors to gain market share. But what if we need to discount more, or along the way we can discount less? So we model discounts from 9% to 21%. And our IRR, as you can see, ranges from 17.7% to 25.1%, after assuming our discounts are 15% of competitor prices like Mothercare or Hopscotch. Next, we modeled a 5% salary inflation, but what if our wages grow faster and along the time we need to pay more to retain our labor? So we tested salary inflation from 1% to 13%, and our IRR ranges from 20% to 22%, and our NPV ranges from 17 crores to 21.1 crores. So what does the sensitivity analysis tell us about our model? One, our model isn't fragile. We tested dozens of scenarios across 3 variables, and every single combination still produces a positive IRR. The range is 17% to 25%. Our base case in our model, which we have taken, is 21.6% IRR, which is right in the middle. So we've modeled the median outcome. Next, our analysis shows that our conditions are broad. Our conditions are broad under which our model finally flips from being from negative to positive. We can be wrong about inventory timing by around 50 days, as you can see. We can be wrong about pricing power by 12 percentage points, or we can even be wrong by a critical variable such as inflation by 8 percentage points. Our sensitivity analysis covers all those variables, and still, our model still works because our IRR and NPV is still flipping positive, even at the most critical point of all these variables. And our model still works. Thank you.
Wonderful presentation, good assumptions, 4%, 5% is very reliable assumptions. And inflation is also good assumption. Hope the budget will also see the similar type of assumptions we have next couple of weeks, right? Okay. One is I'm bit concerned about this competition in this market. Yes. So the way it is growing, and it has grown up, and now I don't know how many people are working on this type of the businesses, right?
Yes.
So how do you address that one?
Right.
Yeah.
So it's obviously a very competitive market, which is why one of the first assumptions we took was our discount. We priced it 15% below competitor pricing, such as Mothercare and Ginny and Johnny. We looked at their prices, and along each of our SKUs, we had modeled it 15% below the competitor prices, because we're starting out with 0 brand awareness, and that is why we chose marketplaces as our second assumption to counter competitiveness. Because we know that customers will be more likely to encounter our new brand on Amazon and Myntra rather than our own website, which is why you can see in our model that our website sales only grow after we have gained brand awareness. So we took 2 of those variables to ensure that competitiveness is not that big of an issue for our model in the beginning.
How many years it will take to build this brand?
We have modeled it across 10 years, and our losses are generated till year 5. And from there it becomes positive. So we have accounted for our website growth to encounter around that time too, and that's when our marketplace dependency becomes less, and we are depending more on our website when our brand awareness
Is it easy to sustain for 5 years?
It's not easy, but we've taken the help of equity infusions and debt to ensure that our model will have reliable cash flows and ensure that we're not sinking into losses too quickly. That's why we decided to take a combination of equity infusions and debt, and it's definitely shown positive EBITDA margins after a certain period in time, which does show that it's self-sustaining and it's able to pull itself out of losses.
Thank you, Niharika. Thank you, Samira. Very good presentation.
Thank you.
Just building upon Sir's point, and more a comment. I think about again that mix between marketplace versus D2C.
Yes.
especially we are going in a world where now we are buying iPhone on Blinkit.
Right.
So if Apple doesn't have that thing of me going on Apple website and buying Apple, and that's very, very sensitive to all your models, isn't it? So I think it's very optimistic to think that your website transactions would be more than your marketplace transactions,
Right,
and think about what kind of sensitivity that had. One question I had, maybe Niharika, you mentioned something about SKUs, isn't it?
Yeah,
And the very
yes.
tight SKUs. But I saw you had a lot of SKUs and you had like children, different
Yeah.
ages, different things. So I didn't understand that point where you said
Right.
the tight SKU point versus
Yes.
what you were showing there.
So 19 SKUs for our model is relatively less compared to Mother Care and Ginny and Johnny, but we have taken a relatively large SKU per our model because we want to be able to cater to all our customer needs. We don't want some customers to leave unhappy because kids wear business is a kind of business in which if you don't have the appropriate SKUs, then you might lose compared to competitors. And competitiveness was one of the factors you have to take into account most of all when you tackle a kids apparel business. So we didn't have a tight, if we don't have enough SKUs, then we are not a competitor in the market, which is why we had to model all of these as per a kids apparel business. We phrased it as having tight SKUs because according to our research, the three competitors which were very central to this model were Mother Care, Ginny and Johnny, and Hopscotch. And we invested their SKU very thoroughly, and they had a lot more SKUs than 19. So comparatively, as in a relative proportion, our SKUs are still tighter compared to those, which is what we meant by tight. Which is enough for our price margins to still become positive over time, but it's also enough to build enough brand awareness with customers to ensure they come back.
Yeah, and absolutely agree with, maybe just think about, are those really your competitors? Because those are much, much bigger brands
Yes.
in a lot more different things than only the kids apparel. Like even within the 9 presentations we have seen right now, this is the 3rd presentation on the brand apparel.
Right.
So is that your competitor or Mother Care your competitor? Second, I think the point you're making now, SKU, I think you need a sufficient number of SKUs to bring the customers in, but balance that with what's the inventory cost and the cost of maintaining those of SKUs.
Absolutely.
So hard answer, but what is that sweet point where you balance the number of SKUs with the cost of having that inventory?
Right.
The other thing I would have liked to share a little bit more, and maybe you have covered it, but you just didn't talk about it, around your conversion rates, traffic. What do you want to do for your CAG around how you're going to get the customers in, how much are you going to spend over time, in what channels to get those customers in, and over a period of time, how is that going to flow down?
Right.
Whether it's got to increase in the first few years and then decrease over a period of time, and how does that impact your model at the end of the day? Because again, one of the biggest costs you will have in a D2C business is the customer
yes.
acquisition
Perfectly
cost.
valid, yeah.
Yeah, but otherwise, yeah, I think you have thought about a lot of things, and great.
Thank you,
Thank
sir.
you.
Thank you so much. Thank you so much.
we have two teams left now. Next team is Srinjit and Mahi. They're from Bombay. All the best.
Thanks.
Okay. Good morning, respected judges, panelists, parents, and my fellow finalists. I'm Mahi, and I've had the pleasure of working alongside my teammate Srinjit to represent our school, Podar International, in the ACUMO Finathon. This was our attempt at building and modeling a financial forecast for a hyperlocal services aggregator, which is the business type that we found the most interesting and also the most challenging. In our entire workbook, before we just get to the valuation, we've developed the entire thing in a very modular structure. So each result can be traced back to something in the inputs and assumption sheet. We'll start to walk you through the structure by going to what we consider paramount, which is the real world business behind all the numbers.
So this is the business narrative plus research sheet. This is basically like a journey of our business from year 0 to year 10. As you can see, we've also done a lot of research. This research is not just for the journey, it also carries over for the rest of this model for any values and assumptions that we take. So throughout these 3 phases, we'll be expanding into multiple cities such as Chennai, Mumbai, Delhi NCR, Kolkata, etc. So in phase 1, we're prioritizing the quality over speed of growth, and we start off in Bangalore. And then in phase 2, we shift our focus to the financial aspects of our business. And then in phase 3, we prioritize repeat customers, as that is what drives the revenue in such businesses. And over here, we have the inputs and assumptions sheet. So this is the only sheet in our entire model in which you can adjust the values and get a result according to that. So we have even color coded the assumptions, and we have divided them into 3 categories: cost, revenue, and miscellaneous. So these green colored ones means that if you increase it by a small percentage, it impacts the end result a lot positively. For the red colored ones, if you increase a little bit, it impacts the final result a lot negatively. And for yellow ones, it increases the impact a lot positively and negatively if you increase the percentage a little bit. Moving on to headcount projections, this is a simple sheet we made just to simplify the growth of our core team and to simplify the salary calculation. And moving on, here's the revenue projections.
Yeah, building on the reasoning transparency that Shinjit showed in the headcount projection sheet, we wanted to explicitly show some second order assumptions that we're making that are also updated based on the inputs and assumption sheet. At the core of this platform-based business are the customer base and the provider base, which is over here, and this is what our entire revenue is built on. Our revenue streams are actually threefold. The preponderance of the revenue comes from transaction-based revenue, which is our GTV times whatever take rate. Over here, we've made an extremely ethical assumption deliberately that our service providers keep at least half of each transaction as they deserve to for their work. Secondly, we have a relatively trivial revenue stream, which is provider-facing subscriptions, which for the providers who can afford it, they have the option to pay for premium listing and additional badges to be featured on the website and app. And thirdly, we have some consumer-facing fees and surcharges, which are a form of dynamic pricing that we're using based on things like price elasticity of demand. And these are also pretty typical surcharges implemented in the industry. All in all, we expect that in year 0, our revenue is a grand total of 0. But in year 1, it increases to 6 crore. And by the time we get to year 10, it's around 37 crore. Of course, all these revenue projections don't appear magically. It's all because of costs, which is the next section we have. Our costs have been divided into various comprehensive categories, but most of our costs are either classified as fixed costs or variable costs. In between, to include some nuance, we also wanted to highlight semi-variable costs to model real-world costs better, which include a fixed base and then some sort of output-linked surcharge. Beyond fixed and variable costs, we also included CapEx, even though we are primarily a platform-based, asset-light business, we did want to prudently include capex for technology hosting costs as well as some other physical assets that we have. And this section is something we thought is pretty neglected, strategic costs. While these might increase our costs in the short term, and we specifically increase the strategic costs in years where we're expanding to new cities within India, they do add long-term value. Bringing this all together, we see that in year 0 itself, our costs are around 6.5 crore, but in year 10, they stabilize to around 26 crore.
So next, we compiled all of the total annual revenue and total and operating costs values. So in year 0, as you can see, obviously our revenue will be 0 and our operating costs total will be 5.8 crore. And as you can see, we have used this to calculate the EBITDA and the EBITDA margin. And over here, we've also done the capex depreciation calculation. So it may look a little complicated, but what we have done is we have done calculated the cumulative capex from year 0 to year 10 horizontally, and we have also made a column for year 0 to year 10 vertically, which shows the declining balance in each year. We add it all up, and the total is in this row. And after that, we also have the interest calculated for any loans that we borrow, and after that, we have the profit before tax and profit after tax. So in the first year, obviously our profit will be minus 7 crore, and in year 1 it is minus 1 crore, but in year 10 we make a profit of 9.8 crore, and our first profit is made in year 6. Moving on to the ultimate sheet, we can say, which is the DCF.
Yeah, before getting to the DCF, I have something small I'd like to share. I was watching an episode of Shark Tank India a few weeks ago, and during that episode, my favorite shark, Anupam Mittal, shared a brilliant quote that comes to mind right now. He said, "Valuation is vanity, profit is sanity, and cash flow is reality." In that spirit, here is our discounted cash flow, which makes all our assumptions very testable and explicit. We start with PAT, to which we add back all the non-cash items like depreciation, net working capital, and change in net working capital to give us our unlevered free cash flow. Of course, these cash flows are driven by operational margins as well as revenue growth. We understand that growth doesn't come for free, and that's why we've also included the capex requirement and cost of investment. And once we adjust for that, we get our levered free cash flow to the firm. These cash flow values are discounted using WACC to get to the present value, accounting for the time value of money as well as the risk of investing in this business. Using all these cash flow values, the present values, we add them up with the terminal value to get the enterprise value, which is the full economic cost of acquiring our business, a little north of 60 crore right now. And the final figure is our IRR, which is almost 30%. This represents the yearly compounding that an investor would get if they backed up our business. This, sir, is the one number that we would show in order to convince an investor, and we hope we've convinced you too. Going beyond as an appendix for extra fun, we wanted to do some simplistic Monte Carlo simulations so that we could almost attempt to model thousands of different inputs and assumptions, but all in a split second. As a result, we, instead of getting a single number for profit and loss, we got a meaningful range, which helps us with risk assessment in the future too. All these scatter plots here, they just show the coefficient to correlation and sensitivity analysis of how each of these inputs and assumptions affects either total revenue or total costs. My teammate will elaborate more on sensitivity analysis, which we wanted to take a step further.
So what we have done is we have taken our base enterprise value from the assumptions, and we have chosen 4 assumptions which affect the revenue, take rate, average booking size, annual provider growth rate, and bookings per provider per month. And we increased and decreased each of these factors by 10% in our assumption sheet. And when we noted down all the values, and as you can see here in this graph, the annual provider growth rate is what affects the enterprise value the most out of these 4 factors. So that means for every 10% increase in the annual provider growth rate, our enterprise value increases by 65.9%. And for every 10% decrease in the annual provider growth rate, our enterprise value decreases by 79%. So obviously, at the end of the day, this is just a model. We can't truly predict a business's path in 10 years, but we believe this is the most disciplined model that we could come up with. And yes, thank you.
Thank you.
To change these things. Do you think next 6 years or 7 years this is sustainable?
So regarding technical feasibility over the next decade, we understand that there can be many unpredictable changes.
Yeah.
The core that we expect right now, and we expect to stay consistent for at least 3 years, intuitively, is the idea that we will have an online platform, an online marketplace similar to current companies like Urban Company and Snabit and other new players as well. An online platform that way, where both sides of the marketplace come together, the customers and the service providers, and of course we're involved too. We have accounted for both efficiencies, like technological efficiencies, decreasing our platform cost over the years, as well as increased hosting and server hosting costs as our customer base and provider base increases. So we've modeled it both ways, considered both scenarios, and combined the two to see how the technological cost might change over 10 years.
No, I'm not talking about the technological cost. It is the model of the business is going to change in the next 10 years. That is how it can be. Is it sustainable with that one? Because the disruptions are coming in a way that we can't predict in the next 3 years what is going to be there.
So I'm very glad and grateful that you mentioned disruptions, because that one word in our business name, hyperlocal, that is the disruption. Hyperlocal translates like district-wise or very granular service provision, translates into quick provision. And we know that one of the biggest disruptions in this decade has been quick services and quick commerce. In fact, right now we think that this business model can be the disruptor. It is an anti-fragile disruptor, precisely because current, like Urban Company, taking them as an example, their business model involves booking 1 day in advance. Hyperlocally, that 1 day booking lag can't be expected because it's for service providers within a very small proximity range. And that's also why we expanded city by city to able to attract a good talent pool of providers in each district from a city. That helps us ride the disruption wave of quick commerce and quick services instead of being afflicted by it.
Okay.
Hey Shranjit, thank you. Great presentation. And I think you guys are the first one to pick this up. It's not an easy one. What are some of the challenges you see with the business overall? What are the biggest risks in running this business?
I think we had done a sensitivity analysis where we learned that the annual provider growth rate affects our enterprise value a lot. So it's very likely that if we don't get enough providers on our platform in year 0, then even like a few providers can make a difference, right? So I think that's the most challenging part, getting convincing enough people to work in our platform. And another thing would be just competition wise, because there's already Urban Company, they have established a very huge presence in India, but obviously that won't be as big of a competition because we are a little different. We are offering premium services, which is what's missing in India. Urban Company, they do have some premium options, but it's not what it's not genuinely premium. They just have the price a little higher. So yeah, so mainly just getting providers on our platform and ensuring that when we expand to another city that our growth remains the same, because you can't obviously have the same growth in every city. So that would be another challenge, because not in every city the demand for premium services will be the same. That's why we have chosen specific cities like Mumbai, Bangalore, Kolkata. These are more metropolitan cities who will enjoy these kind of services. But yes, so those are our main factors.
Sorry, so if I may, just building on Shrinjit's response, he mentioned Urban Company. That is our incumbent competitor, indeed. But we anticipate that the new competition that we would expect would probably be companies like Snabit or Dazzle, which are currently challenging Urban Company itself. We expect them to be our competition. Both of them raised rounds as well recently. But we do feel like by capturing other cities where these where Snapbit and Dazzle don't have as much of a presence, we can overcome that risk.
Yeah,
So it is a
and-
relatively unsaturated market.
And I think Snapbit, companies like Snapbit will be a much bigger competition because their business model is almost opposite to us. They offer very cheap service very quickly. We are offering premium services. So I think that will be a very, very strong competition compared to urban company. Urban companies, like, everyone can afford.
No, I agree, and I think you
Yes.
guys. I think how do you scale up the business? How many providers you have on the business? Obviously, biggest challenge. And as you move to the new cities, obviously that compounds itself. I think some of the cost assumptions you took seemed a little bit on the lower side to me. I think you had put 2 lakhs somewhere as an advertising cost to go into a new city. That sounds like a rounding error for a 2 lakh to go into a new city. I think you will have a lot more cost to go into new cities. So think about those costs in a little bit more detail because, yeah, as you rightly, you rightly said, I think how you scale up, how you have providers, and especially the second part, because you're saying you're the premium, as that's what differentiates you from a Snapbit or something. How do you maintain the quality of that premium? Because in this model, the quality can be pretty fragmented, isn't it? Because you don't have the direct control over your end providers. So how do you maintain that quality? And to maintain that quality, your cost will automatically go up. So have you taken that into account into your model?
Yes.
Will have a impact on the sensitivity of your model.
Yes, sir. Thank you. We will keep that in consideration. I believe the 2 lakh must have been like a city pop-up event, but even that could be considered inadequate for an effective marketing campaign. Regarding your question on quality, so we have included a base training cost for each and every provider, and this scales as our number of providers scale. So even though our providers might be part-time or even gig workers, that's how they might be classified, they do receive very thorough training, and we've accounted for the costs of that. We've also, to maintain kind of the close-knit community of providers within a city, we've accounted for an employee referral program, because we expect that our existing service providers would help us with recruitment for further service providers, and that's what fuels the annual provider growth rate variable that we mentioned. So quality checking and assurance has also been included as a cost, as well as training.
Okay, cool. No, thank you. But otherwise, great job. Okay, thank you.
Thank you. You can sit. Mahi, you can sit.
Yeah. Go ahead.
Okay.
All right. Good morning. Yeah, good morning. For us, firstly, finance is not just about numbers. It's about business, economics, and psychology, and how it all intersects in this real world. Our business, Cotton Kind, is a D2C e-commerce kidswear brand that caters to the urban growing middle class and sells affordable bamboo cotton clothing. Our two main priorities are price and quality to ensure utmost consumer satisfaction and gain long-term profitability. So let's begin with the revenue projection.
So overall, our So our revenue is completely based out of our 3 marketing strategies, which are spend on influencer collabs, Google Meta ads, and organic traffic. So as you can see, in the initial years, our organic traffic is much lower as compared to paid traffic. But as you move towards year 10 or year 11, our paid traffic is much lower as compared to organic traffic. This happens because as our SEO compounds and as our content starts ranking higher in the social media, our organic traffic starts to compound aggressively, and hence it is higher. Okay, so let's get into the organic traffic. This is one of the most important part of our entire model. So this is divided into two major parts. One is our own content and one is search engine optimization. So for our own content, we calculated orders according to the number of followers, and then we took the conversion and traffic. And for the SEO, we divided this into three main brackets, which is low tail keywords, mid tail keywords, and long tail keywords. So long tail keywords are essentially the keywords that high intent consumers type in the browsers. So we have aggressively focused on those kind of customers in the initial years to keep our organic conversion rates high and have an effective marketing strategy in the long run. So now let's move on to the brand ambassadors.
Okay, so we are introducing brand ambassadors in year 5. Now this is to act as a multiplier to our credibility. Now if we were to introduce it in the year 1, we believe that it would just lead to a short-term retention of our customers. However, the marketing methods that we're employing early on leads to a long-term retention of customers, and then the introduction of brand ambassador in the later years just amplifies that to our credibility, trust and revenue. Going ahead, we have the LTV to CAC now. Over here, let's begin with our CAC. It's high in the initial years, if you notice. That's because and then it decreases. It has a downward trend as we go ahead. So this is because the marketing efficiency over a period of time increases due to the proliferation of organic traffic and the word of mouth increasing. Now let's look at the churn rate. Churn rate and purchase frequency have been derived by giving a weight of retention probability and purchases per year to 3 types of buyer types. And the purchase frequency increases year on year and the churn rate decreases year on year. This leads to an increasing LTV to CAC ratio throughout the years, and as the brand ambassadors are introduced, we observe a greater increase in the LTV to CAC ratio. Now we move on to the unit economics. Over here, if you look at the average selling price, it's a 800 rupees in the year 1. That's the base average selling price. This is to position us below the premium market. Now the discount rate. Now if you notice this, it's 20% throughout the years. That's because it's an average discount rate that we have considered. Throughout the year, in the whole year, the business will offer various types of discounts. There will be various sales, flash sales, end of season sales. So this is like an average rate of it all. Now if you look at the contribution margin, it is negative in the first 2 years. However, it turns positive by year 3. And this is because we achieve economies of scale and also the fact that our negotiation power increases. Moving ahead, we have the cash flow.
Yeah, so to calculate the cash flow, we have taken change in inventory and change in trade payables majorly to account, as we don't have any trade receivables in this business. So basically the inventory is calculated on cost, so like to comply with the concept of prudence, and also to measure the inventory accurately, we have included the sales returns too. And also this allows us to have an IRR for the long term as 15%. This is a little lower than what new D2C e-commerce brands are having, because we are sacrificing our margins in the initial years to have a higher growth in the long run and have a stronger customer base.
All right. Yeah. Now moving on to the financial model, the income statement. Over here, all the expenses are inflation adjusted. We are breaking even in year 7, and we are reaching our SOM by year 3. The SOM is around of 3 CR. Now, if we look at the key insights and assumptions, these 4 metrics are highly sensitive to our IRR. Firstly, let's think of sales return. If we increase our sales return, or like basically if it is more than what we have projected, suppose let's take 22, it decreases our IRR. Now to mitigate this risk, what our business is planning on to doing is that we'll invest in technology. We will ensure that there's 3D sizing, AR try-ons. We will obviously increase the quality check efficiency year on year, and also have prompt action to our consumer feedback. Discounts allowed. Over here, the discounts allowed for this, we are planning on to hiring demand forecasters, so that the timing at which our discounts are offered is efficient, and instead of bearing losses, it just increases or contributes to our total revenue. The selling price. Now this is an observation that we have made as well as the research said. The Indian consumers or the Indian market in general is highly price sensitive. But when it comes to kids wear, parents are very cautious, or they want the best for their kids. So they are willing to pay a slight premium to it as well. So what it does is that it gives a room to increase our average selling price over the years, as well as it slightly increases the consumer surplus as well. So this also decreases the average selling price sensitivity as we go ahead. Okay, moving forward, we have the assumptions. Now these are all the assumptions, minor, major, everything that we have accounted for in this financial model that we have taken with the sources and rationale. We have taken from the official websites and also refer to research papers from reputed organizations such as McKinsey as well. Moving forward, we have the key learnings that Karan will.
Yeah. So one thing that we realize is that for any e-commerce D2C brand, the main the main factor that decides its success is the level of marketing. So what is your marketing strategy? How well do you optimize the spending? So that is something that we are focused on. Along with that, we have realized that the main asset of our entire business is the customer, and the way how well do we hold the customer over the long run plays a significant role in how we grow our business. So to achieve both of these things, we have ensured that we focus on social media a lot, because the Gen Z parents are often driven by all the social media things to purchase these kinds of kids wear clothing. So this is how we have strategized our marketing. So while strategizing this, we also believe that most of e-commerce brands will start making losses as aggressive marketing is needed. So another critical factor here is the financing of these losses. So losses can be huge till in the initial years. So the finance costs, capital costs may rise, and they must be managed well for the business to sustain in the long run. Also, for example, we are taking investor seed round in year 1. And we think that this is achievable because firstly, we operate in a niche, sustainable and growing market, which is the kids wear bamboo cotton industry. And investors may be really interested in this field. Also, we have an IRR of about 15%, which is
I had changed the
which is 15%, and it is a little higher than the broader market returns that an investor can get. And the third thing is that we have a clear exit plan for the investor, and we aim to have an IPO by year 12 or year 13, which may be India's first kids wear IPO. Yes.
Thank you.
Thanks, Karan. Thanks, Nishta. Good presentation. Thank you. Maybe, Karan, what you said towards the end, isn't it, which was quite fascinating, which you said bamboo cotton. That's the first time I heard it, the whole presentation towards the end. Is that the USP of your brand, the bamboo cotton?
Yes.
Okay. And if that's the case, then please emphasize that on right at the beginning of because how do you going to differentiate? Okay, maybe I missed it. So because I thought I heard it, but because I think, again, in this market, as you rightly, how do you build your brand, isn't it? And how do you differentiate yourself with 20 other brands in that market? So what's your USP? So yeah, emphasize on that. I'm sorry if I missed that somewhere. I think you guys have been really thorough, isn't it? That's I think some of the assumptions you guys have thought about, especially on the marketing side, and where do you spend money? Great. Because again, you will need to think about what's your CAG and where your marketing is spent and everything. Think a little bit more about the inventory cost and the SKUs and how many SKUs do you want to?
We have incorporated that.
Let me just show that. In the assumption, in the product development cost, we have calculated that with the number of SKUs. That's how we have calculated that.
So we think that number of SKUs plays a huge role in while calculating the product development cost. So it gives a better idea for the figures.
So this has been indirectly anyways linked and integrated in our income statement and all the other outputs that we are getting as well, because it's all linked.
Yeah, because SKUs is very important for a D2C business. So do the sensitivity analysis also a little bit on that. But otherwise, very good presentation. Thank you.
Thank you.
Thank you.
appreciate your excellent work of building this business model, and I'm very much impressed with the number of assumptions you have taken very meticulously. And regarding CSA, still my apprehension is maybe you have understated that one, because understated that one, or that means slightly lower side, it may be CSE, customer acquisition cost. I think in the competitive market now, to build this is not an easy thing. Customer acquisition cost is very, very high. And the second is, of course, surviving with 2 years negative contribution margin is, I don't know, is it feasible? How can we, because not covering the just variable cost is also very difficult, right?
Yes.
So these are my two observations. Otherwise, you have done excellent work in building this model, right? Of course, brand and competition, these things holds good. I join with him.
Sir, just to add to your CAC point, so in the initial years, if you see, our CAC is around 850, in the ranges of 850, which is much higher as compared to industry averages of around 750.
And another thing, to that, considering that this is a kids wear industry, after a period of time, kids wear, okay, now if one parent tells the other parent that my kid, this particular brand is suiting my kid very well, because the material, the quality, it matters a lot when it comes to kids, right? So the word of mouth also plays a very big role. It's not just about the spend we are doing on customer acquisition by that, but also the other non-financial factors that affect our customer acquisition. That is multiplying our revenue. That's one thing to consider.
Okay. Yeah. Thank you, sir.
That brings us to the end of our presentations.
Should I close this?
I've been very impressed, as I mentioned, over the last 2-3 months working with these amazing kids.
The mic.
Before we wind up, we break for coffee and then we have the talk, which course is being launched by DC. But I would like Rob to say a few words.
Yeah. First of all, I compliment all the students who have actively participated and made wonderful presentations, and all that credit goes to the ACUMO team as well as the schools from where they have been trained, and not an easy thing, because the building up this many number of the Excel sheets with considering various assumptions and all that one. Sometimes I felt also that I'm out of business now, right? They are going to make me out of the business. So this is how the quality of the presentations, and you have very good understanding about the business field, markets, the products, and the models which currently going on, and how these models are going to change over a period of time. All this is, you have very good understanding. This indicates that we are moving towards a field of entrepreneurship, and more entrepreneurs are going to come in the coming years. That's where India is, whatever the growth we are anticipating. I'm sure that with this type of the thinking of entrepreneurship, the risk-taking ability, that is very much important. So the risk-taking ability is expected to go up with this type of the competitions. I thought, first of all, it's a financial literacy or something is, okay, something financial literacy side, but it's not literacy. It is something advanced model building, and complement the students, complement the teachers who have helped them, and complement the mentors who have spent a lot of time, and where these people got a lot of inputs, and please continue this. I'm sure that these people who could not reach this final level certainly must have been done very good work also, but once it's a competition, we have to discriminate here and there. That is the final thing. Otherwise, it's a big challenge for us to discriminate who will be the standing first in this one. And it is certainly not an objective evaluation from my side. I can say that because lot of presentations, all are good, very good presentations, lot of work you have done, and appreciate all these things.
I would just like to also take this time to thank sir. Without his support, we would not have been able to do this competition. So thank you very much, sir. Without your support and INSTI's support, this would not have been possible. Sir has to leave, so we just want to give him a small memento.
No, we can wait for some time.
Okay.
Yeah.
Okay, right. So we'll break for coffee and then we'll have
Better not have coffee there, coffee is. They have been sitting for last 2.5 hours.
So let's get back in by 12. That's when we have the UG courses talk. And then after that, we'll announce the results.
No, I will not stay, but we should I finalize. Yeah, fine.
कंप्यूटर पे सेव ABCD भी नहीं आता अच्छा था वेरी गुड
Yeah. You are from great initiative. No, it is not my initiative. It is their initiative. And we will come back after, but we are finalizing.
Aishwarya, coffee is there, please.
My friends are coming. Like I don't know where they are right now, but when they come,
Write my name.
Now you know the direction.
Yeah, no, I know the direction, but can I leave them if I'm interested? Then I will let them know to wait.
Won't look good at it.
I doesn't right now then.
Till 12:30 तो होगा.
Stand. এখান থেকে না go or just solo first and then no both of you go अच्छा okay solo এখান থেকে না straight come go keep it
I'll change angle. You can do two sides, yeah. That's it. Super. Smile again. Perfect.
thank you
You're a single mind?
single you can take no
You're okay?
thank you how was yours we weren't here I'm sure it was great what did you go to a live stream that's
Thanks a lot. Hey, but these were like 2.5 hours. Hi. Because we are leaving and Can we get that background on the screen for clicking a picture?
Okay, that's it.
Depending on either.
No, but first it should come there. That one girl who spoke about the chocolates was in bits.
Wasn't bit. Oh, very confident was Bunny though.
She is doing a course. She did a 1-month course.
Must be roommate.
Yeah, we fully stopped her LinkedIn. So
She has a LinkedIn.
she has an updated LinkedIn.
Because she, as you were saying, she's already qualified for
IIT.
How can that
No,
be
it
possible?
wasn't IIT as a student. It was some course only, but she's doing it there, like ENAC. We stopped it to
Education.
education, and then she did some course from Ashoka University also. Ashoka. And that other Ashoka. Whereas it's
not a backlink.
yeah, so that's why my hand is touched. That's why it doesn't normally give you when you start your class. That's suspicious. That one guy. Aswin. Okay, bye-bye.
Hats off to you guys. You great job and came back. Like, you know, it's.
Sure, if I like get stuck in Delhi, I am from Madhya Pradesh.
Before the talk, we just want to present Sir with a small memento, token of our thanks and our appreciation. No plastic items, sir. If you can just face this.
Landfill items and all that.
Thank you. Thank you, sir.
Shall I start? Okay, good morning.
Good morning, sir.
My name is Jose. I teach at IIM Bangalore. I'm a colleague of Professor Jaydev. I teach in the strategy area. I've been here for the last 25 years. So that's a long time, right? So welcome to IIMB. I'm older than most of you. Are you having a good time here?
Yes, sir.
Okay. So Preetha asked me that I should speak about our undergraduate program, which is a program that we have just launched this year, or towards the later part of last year. And the first batch will be coming online, not online, coming into the campus in August of 2026. So I don't know, anyone in this group who has applied to our program? Nobody? Okay, but I just thought I'd make sure that. Okay, so Preetha also said that, did you have a chance to look around our campus so far? Yes. You did. You like the campus, right? Yes. It's beautiful. How about the parents? It's really nice, right? Yeah, it's a beautiful campus. It's a 102-acre campus. If you look around, you find it's very rich in biodiversity. We have over 258 species of plants here. A huge variety of birds, if you like bird watching. I don't know whether you can organize bird watching tour. Maybe she'll organize it for you. Some weekends they do that. A huge amount of butterflies, and I think over 200 varieties of birds have been spotted here. We have a bookshop that has actually a book on birds of IIM Bangalore. It's a beautiful campus, and it's probably the green lung in this part of the city. We are now building, so that's what you see at the background there, student life here. Something that you can hope to join if you join us at some point of time. This all looks a lot of fun. It's not so much fun, there is a lot of work also, okay? They work very hard. At least we think they do. We try to make them work very hard. So I can talk about our undergraduate program and also about the MBA program if you want to know anything about it. But let me start with the undergraduate program. We are building a new campus about 30 kilometers from here. And we are setting up a new program called the School of Multidisciplinary Studies. So that's the new campus. We only have one building there, and that's going to be our home for the next 2 years. But we are building a fully self-contained large campus. This is about 110 acres, what you see there. And we have kind of carved out 33 acres of that to build a campus that will house about 2,400 students. So eventually it will be bigger than this. That's going to be an undergraduate program. IIMB has not done undergraduate programs in campus before. We do have one online undergraduate program, but that's online. That's not the same as being on campus. This is going to be a fully residential program. And there are 4 disciplines that we will be offering. 2 are being offered from this year, and we will start 2 more, I think, in another 2 or 3 years when we have the campus ready. Right now, there's limited infrastructure there. So what we are starting with this year is data science and economics. So data science major and economics minor and some courses in business studies, or economics major and data science minor and some courses in business studies. And let me just clarify by saying this is not a BBA. There is no direct entry to an MBA program. We are trying to build an undergraduate program with a liberal arts focus. Do you guys know what liberal arts is? Okay. So, you know, my kids studied in a liberal arts college, and frankly, when they asked me, I said it's something. I didn't know what it was either, right? What happens in our education system is that we kind of, you know, get people to focus on something. For example, I graduated in physics and math and computers. We studied only that, right? And I thought maybe psychology and all that were subjects, not great subjects, right? And so on. History, nobody studied because it's all remembering things and so on. However, you realize that in today's world, the skills required are very different. You need some more skills because you can get any information you want today. What is required is the ability to think critically, to work in teams, to have a broader perspective of the world around us, to understand history, politics, religion, also other things, right? I don't know whether you know, recently somebody was telling me that Google is now has created the post of a chief philosopher, right? Because these subjects are very important. It's not enough to know science and math, and it's very important, of course, but you also need to understand how to think, how to work in teams. You know, there are a lot of skills that one needs. Life skills you need. You need some, you know, understanding of culture and so on. So we thought we would create a program that will combine the best of both. In other words, in 4 years, you would have a good understanding, a deep knowledge of a subject, which can potentially get you a job or prepare you for higher studies. In the first instance, that would be economics and data sciences. Subsequently, sustainability and psychology in the subsequent years. But along with that, we will give you good skills in writing, for instance. It's a communication. This is a skill that's missing. Leadership skills, critical thinking skills, understanding data, you know, logical thinking. It's not about math. We are not going to teach you programming, but we're going to teach you about logical structures and stuff like that, right? So we want to create a program that has the best elements of liberal arts. That means it allows you to think broadly, but it also has the best elements of some sciences and some hard subjects like, you know, data and math and economics and so on. So that's the plan. Are there similar programs like this in India? There are. And if you want to think about, I think the 2 or 3 programs that I can think of are Ashoka in Delhi, Flame, Priya. There are several others. And across the world, some really outstanding schools are there in US, Europe, and so on. But the IIMs don't have a program of this kind. And what we are doing is we are trying to bring in our own special, you know, whatever ingredients we have, secret sauce into this to create a program that's really world class. So it's benchmarked on the best programs in India and abroad. It's fully residential. It is more affordable than most programs comparable programs you will find anywhere in the world, but it's not very inexpensive. It has some fees associated with it. But the IIMB philosophy is that once you make it to the program, then it's up. We will make it possible for you to join and stay in the program, regardless of financial background and all that. As long as you get an admission, then we will help you find your way through the fees and all of that. So that's what the program is. We're launching it this year. We just finished the entrance exam, which was in December. We had exams in about 40 centers across the country. We've shortlisted some people. The interviews start in another 2 weeks, February 1st week, and the offers will go out maybe in the middle of February. So if anyone is interested in looking at this program, then I would recommend that you look at our website. I can also answer any questions about this or the MBA program that you might have. And then, of course, do apply. I think the next cycle of admissions will happen in November. Most likely, the third Sunday of November will be when the entrance will be there. So if you're in 11th standard, this is the right time to start preparing for it, and then, you know, apply for it. That's sum and substance of what our program is like. I can answer any questions you have on this. I'm sure parents will have more questions. Yes, sir.
Thanks for
Yeah.
this overview, and it was very interesting that this will give a kind of different education which not many institutes are offering and coming from IMPs.
Right.
Couple of questions from my side. One is when
You want the mic, I think, because others might want to also. People online may not be able to listen to you. Okay. Just give me 1 second. Okay, go ahead.
So first question is, once the student completes graduation, then what kind of employability is available? Because this is not an engineering course, so to say. And the other question is that after this, if the student wants to pursue any PG courses, then what kind of PG courses are available for them, and they may not pursue because this is a BSc program.
Correct. So you're not going to like what I say. Some of my colleagues also don't like it. But, I have to say that, see, employment is an outcome of education. My philosophy is that you can't drive education with employment, right? Unfortunately, it's my own personal view, please, not IMB's point of view, that the MBA program is driven by the education, by the employment rather than by what people learn here. I feel this is the wrong way to put education. We believe that if you give good education, people will find jobs. And we are seeing that across, right? I'm looking at the other places and so on. Does that mean that we will not help the student find a job? No, we will help. We'll have a career development office, which will help you to prepare for a job. We'll invite companies. But in my mind, I'm very clear while I'm there that that's not going to be a placement agency for anyone. Because we want students to learn, right? And then I think the outcome will be good. You don't have to be focused on the jobs. The jobs will come because the jobs are there. But the kind of jobs that you will find 4 years down the line are not the kind of jobs you will find today. Which is why a liberal arts oriented education is very important, because skills people are looking for are not just programming or some such skills. Those skills are all automated today, right? Not even accounting skills, because they can all be automated. This is about being able to work with people, being able to think for yourself, have a better understanding of the world, and have some deep knowledge of the subjects that you're interested in. So we are going to shape careers. We are not going to give jobs. We are going to help them learn. And in learning in today's world, it's very important to unlearn and learn. Because whatever you learn today, and you shouldn't listen to me, it's only for the parents, will become irrelevant in another 2-3 years. That's the reality, right? And therefore, the important skill tomorrow is actually learnability, not what we teach you. And in class. And we will teach you how to learn and unlearn and all of that. So that's the focus. Jobs for me are an outcome. It's like the score of the game. You play the game well, the score is good. And we should see it that way, right? Now for higher studies, this is like any honors program. So they could go into any master's program or a PhD program. I can't really tell you the specifics, but there are schools in other parts of the world, at least some of them have been talking to us, and they are saying that, well, if you have this great batch of students, at least some of them will give them a direct entry into their masters. But this is not a commitment, because things can change in 4 years, right? And but those are possibilities. Now the new education policy allows you to even exit after 3 years or 4 years. Both possibilities are there, and we will give those options. At the end of 4th year, we expect some will go on to find jobs because they will be job ready. We'll expect some of them to go on to do higher studies, because we would like to develop in our students a spirit of inquiry, and we want some of them to do higher studies, do PhD and so on. So that's the way it is. So it's a little different from an MBA program. In the MBA program, the job is guaranteed at the end of the program, and many people come because the job is there. It's also a bit unfortunate, because once they come, they think the job is theirs and then they stop studying, which is what we don't really want to have. So we have, that school is separate, and there is no automatic entry into the MBA program at all. I hope that answers? Yeah. Okay.
It's very helpful.
Thank you. Any other questions? Sorry, I'm just being very frank and open with you, because we should know, right? Yeah. Yes, please.
So you spoke about I have two questions. One is, you spoke about new programs getting launched maybe after a year or two. Specifically with regards to 2027, is there any new program that is going to be launched? Question one. And question two, what exactly, when you're looking at the evaluating a student for admission, one is, yes, there is a test, then there's an interview you spoke about. So if you could, talk a bit more about what helps students, or what are you looking for in those evaluations so it can help students prepare well for a selection?
Okay, thank you. Good question. So, first of all, I don't think we will have any new program starting in 27. The reason is the campus is not ready yet, and our model is fully residential, which means that we can only take about 80 students per batch. It's a very low number because we had over 12,000, nearly close to 12,000 applications. So the selection is very, very, it's very selective. That's not because we want to keep it exclusive. It's simply because we don't have the capacity, right? The earliest we will introduce new programs, maybe I would say in 28, 29. That's when this is what I think will happen, because we expect our campus, full campus, to be ready in by I think another 2-3 years. The construction has not started yet, but the plans are all ready. So then we will have psychology and sustainability. That's the first one. In terms of entrance, this is data science and economics currently. We don't expect you to know economics or data science because that's what we're going to teach you. However, we expect you to have a good understanding of mathematics. And the entrance exam has 3 elements. That's what was this year. Next year, I cannot tell you what it will be because we are also learning, right? So this year we had English. Then there was data analysis and data interpretation and quantitative analysis. English comprehension, verbal ability, English comprehension, and data analysis and data and quantitative analysis. Now, English is not a mandatory requirement in the sense that we would like people to have a good understanding of English, but we are confident that even if your English is not perfect, it doesn't really matter. We will be able to make up for that by offering courses or some additional training. So you have to do reasonably well, but you don't really have to do exceptionally well in English, because we want to give an opportunity also to those smart students who are located across the country, who are not in cities, but who are really smart. But because they don't have good command over English, they sometimes refused admission, right? So that part is, there it is. But math and quantitative analysis and data and so on, we expect some good level of understanding. The entrance basically picks up from the NCERT syllabus. And you have to do well in that to get a call. I think this year, if you were in the general pool, you had to get about 80 percentile to be called for the interview. There's a cutoff for that. The reason is also very simple, that this is very math oriented, at least for the first 2 programs. There will be quite a bit of math, and we don't want to bring in people who are not comfortable with that and then struggle through the program. Subsequently, when we introduce other disciplines, psychology and sustainability, I think the emphasis on quantitative analysis and data interpretation will reduce a little bit. So right now that's the way it is.
What about grade 11? Because by the way, when you're interviewing them, they have
Correct.
cleared their
That's
grade
true.
12 board exams. How much emphasis is there on grade 11?
So we have a minimum requirement. That was this year's. I cannot tell you anything about next year because we are going to review all the data. And I don't make this decision. We have an admission committee which makes this decision. But this year we had a kind of qualifying criteria that unless you had, first of all, you should have taken math in 10th, 11th, and 12th. And you should have got at least 60% to qualify. Beyond that, I think there is no requirement. So we are not really worried whether you got 100 or 61, it doesn't matter. You can apply. And then it depends on your performance in the exam. The performance in the exam also contributes only to some percentage of your total evaluation. The interview also will be very important. So interview we are looking at, yeah, you go ahead.
When you say math, applied maths is also included.
Any math, at the moment any math, because again we discovered that if it depends on which stream. If you are coming from IGCSE or IB, then a lot of people go for applied math. If you're talking about NCERT, I don't think they have applied math, right? So India has so many boards and syllabus and all of that. So we just said math. But the syllabus for the exam is NCERT. Question? Yes. We can, there's one more here. Thank you. You can press that, it may work. Try. Can you hear me? No, it's not working. Use this. Thank you.
Firstly, the students in this program, will they only be Indians, or is there going to be an allowance for international students?
Okay. So the rule, Government of India rule is any overseas citizen of India is treated as an Indian citizen. So overseas citizen of India need not be an Indian citizen, right? And I'm not referring to NRIs because that's one category, or OCI is another category. They're all eligible to apply. So, and we have had people from, OCIs and NRIs and students in India applying. In the future, I think we will open it up to international students. I mean, non-OCIs, that means people of not with an Indian origin. But it may not happen immediately. Once again, we don't really have the capacity to absorb more people. That is the only reason. But we will, in the future, we will go. Yes.
May I ask another one?
Sure. Sorry, yeah.
For the tests and the interviews, what particularly are we looking at? Because considering it's a liberal arts program, would there be a more holistic approach to the selection? Like, let's say you have research papers and internships and everything. Do they consider that? Are there any essays?
We look at all of that. Please don't mistake liberal arts means, sometimes liberal arts has some connotations about some well-known institutions in this country which are left-leaning and all that. That is not liberal arts in our definition, okay? In fact, our school is called School of Multidisciplinary Studies for that reason. It has a liberal arts orientation. It is not left or right-leaning. It is just, which means you have a broader perspective, history, geography, politics, everything will be taught to the extent possible, right? That's what it means. And so we will look at your general understanding of the world around you. We will look at your curiosity. We will look at how you deal with, how you, I mean, there's a certain set of criteria, but basically we are trying to see how well you fit in with our idea of, who should be the candidate inside. So what can I say more than that? We're not going to, deep dive into your mathematical abilities in the interview, because we've already tested that. Some basic stuff people may ask. Yes? Yes. Yes, eventually it will, right now the plan is to go up to about 300 per batch in the next, I think, 3 or 4 years, maybe more, I think. But at the end of 10 years, we should have about 600 per batch. So we will increase very gradually because we have to ensure that the quality of life on the campus is maintained. And the facilities are going to be world class. They're really going to be very good. I wish I could have shown, I don't have that here, but we have a really state-of-the-art campus that's coming up. Yes? Okay, you speak and I'll repeat your question for the online people. Correct.
Will give them an edge while applying, or will give them as a matter and will only be driven by understanding of mathematics and
Yeah, so see, if you've taken economics and data science in 11th and 12th, you clearly know that you want to do this. So that's an advantage for them once they join the program. They might have advantages in the initial courses because they will all be introductory courses for everybody. Beyond that, I think there is no particular advantage. So I think everybody is on equal ground. No. Some basic question, maybe somebody will ask, what is GDP? That everybody knows, right? So we are taking people to teach them economics, right? So there's no problem with that. In fact, we'll also have some courses on science also, at least a course on scientific inquiry, because we need that, right? And we'll have some courses on financial literacy. We need that today. So that's what I meant by liberal, right? You can't say I'm an accountant, therefore I will not understand science. That's not possible in the real world today. So we will have, scientific inquiry, but you must also know financial literacy. You should also know about global politics. So those kind of things, but they're all going to be kind of woven into the overall curriculum.
So you mentioned you're beginning with two options, right?
Yeah.
One data science major and the other one is economics major. So is the entrance exam common for both the formats? Meaning a student
Yes.
can apply to both of them, or has to apply only?
No, you can apply to both, and a student after coming in has an option to move also. That is the beauty of this orientation, that you discover after 1 year that you like something else more, you can shift. It's flexible. The whole idea of a liberal education, as it was originally visualized, is that when you get into a college, you explore everything that you can possibly explore. It's like a menu of lots of subjects, and then you deep dive into what you like. Unfortunately, in our education system, either you or your children decide by the time they're in 5th or 6th or 7th, I will become an engineer or doctor or something, and then we kind of drill them on those lines. It works for some, it doesn't work for some. We are looking for those people who are not really hell-bent on being an engineer or something, or a doctor or something. They just want to explore life. And I can tell you, my kids did science, so I forced them to do science till the 12th, because I think scientific understanding is very important. And then they left science, they didn't like science. They're doing reasonably okay. And this is the time we should let children do that, right? Give them the option to follow their passion, because we are today in an age, in a time where you can do exceptionally well in any field that you choose to. You can be a fashion designer, you can be an actor, influencer, whatever you want to be, right? That was not the kind of situation when I studied. You could be a doctor or a teacher or an engineer, finished. And then regardless of what you were, you tried for a government job or any job, some job, right? That's not the world we live in today. And I think we have to prepare our students or our kids to be able to handle that world that's changing, very rapid changes. Different jobs that we are talking about today, they didn't have, nobody had heard about them before, right? So the world is changing, and so we are going to prepare these kids to be ready and adaptable in a changing world. We are to summarize, sorry, might sound cliched, we are preparing them for the future. What we've been doing so far with our education is, working on the past and preparing for the past. The past is gone. How much time we have, Preetha? Because you said 12:30 and it's 12:40 already. Okay, I'm happy to take questions, but you have to tell when to stop. I'll stop, yes. Yeah. Yes. 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 So BSc is after 3 years. BSc Honours is after 4 years. And I think if you want to study in the US, you need 16 years of education. In the UK, I think you can go for a master's after 15 years of education. So different countries have different rules. So one could exit. But whatever I've seen from other places, generally people don't exit after 3 years. They go after 4 years. But it really depends. That's the education policy. So in theory, you can exit after 1 year, 2 year, 3 year, 4 years also. But we don't give those options. Only 3 and 4. Yes?
Will you be facilitating
No. This is going to be tough as it is. I made it sound very exciting, but it is going to be tough. Dual degree will not be possible. But why do you need a dual degree? The way this is structured is you can major in economics, minor in data science. Why would you want a dual degree? I don't know. I'm not sure. In fact, instead of spending so much time on a dual degree, we would really appreciate if you spend time in music, drama, all of that's going to be there. Not in the next 2 years, but once the campus is up, We have all of that. We have a theater for performing arts, center for performing arts. We have a theater. We'll have people who will teach music, dance, and all of that stuff. So, and sports will be certainly mandatory in the school. So that's what is meant by a holistic liberal education, right? So you will have to play sports, some level of proficiency. We're not going to tell you do this, but all of that, can only happen after the full campus is up. Right now, it's just one building and some limited facilities, which are pretty good, but not enough to do this. The whole range of activities. They will come up very quickly. Yes.
Well, it's very beautiful to see that IIM Bangalore kind of institution coming in undergrad programs. My question is, while selection, how much importance do you give apart from the academic excellence, to say athletics or to say while selection? Do you really?
Yes, we do. But see, I've had students writing to me saying I'm a national level taekwondo champion or a national shooter, and so people have asked, and then they've said, will we get a preference? No, I think I would certainly like to have people like that, but it's not fair to such people to come to our campus because there are no facilities, right? So we have to be, you also have to be reasonable. You might be a national level boxer or something, but or a swimmer, a swimming champion. Our pool is not even up yet. So therefore, I think while we will certainly, kind of give them some favorable, advantage, but you should think seriously whether you want such kids to come here, because right now this is not the place for that. Right? I'm just being absolutely honest with you. Okay, I mean, you have to understand campuses take a lot of time to develop, and then if you are, if you're a swimming champion, you need a set of peer, people who will actually swim along with you. All of that's not happening now. We'll have coaches and sports and all of that, but everything will take some time to develop. Right now, it is kind of in a very limited space with limited facilities. Yes. Yes. So we will put all of that on the web. There is weightage. I think that's it. So thank you all. And if you have any questions, you can write to ugadmissions@iimb. They will respond to you. But please don't write for the next 15, 20 days because they're all very busy with the admissions process. And they get a lot of mails already. So after February, I think mid-February would be a good time to write. And the website also will have more information. Also, I think, we will be announcing the next year's intake somewhere, I think, in maybe early March. So if you're interested, then of course you can look at the website and so on. And so don't worry about coaching centers and all that. I think they already started coaching. It's really not required, I feel. All you need to do is just follow the NCERT syllabus. That's what we're going to do. At least that's a plan for the future. If there's any change, we'll announce it on the web. Thank you.
Thank you so much. We well understand the parents' enthusiasm. We like to listen to smart people. Thank you.
No, it's a pleasure. Sorry. All is not required, but please. Thank you so much. Thank you all.
announce the results. This is one segment that actually, honestly, I'm not looking forward to. Uh, while all the question answer was going on, I was pretty clear that I was on this side of the fence, and I was almost like mentally egging on the teams to answer all the questions. So it's been very difficult. I think Sir also mentioned, and so did Anuj, that it was really, really difficult to discriminate and just pick out a winner amongst teams. So we've come to a conclusion, but let me just reiterate again that the teams were really, really close. Great job, everyone. It's been a privilege and an honor to work with you guys. Having said that, so we'd originally thought a first prize, and the first runners-up, but we discussed, and we'll be having two first runners-ups, so two people who jointly came in second, two teams, and there's one first team, right? So the two teams which have come second, the first team, Mahi and Shinjit. So we'll send you guys a proper set of trophies because we had only one built out. Thanks, guys. The second team, first runners-up, Anirudh and Bhavya. And finally, the winners, Nakul and Rohan. Come this side, come this side. Come, you guys. So we're almost at the close. Please join us for lunch. But before we close, we have a vote of thanks. So we started this journey about 3-4 months back, and in a very short space of time, we saw a lot of enthusiasm and a lot of participation, which we did not really expect the extent of. And a lot of the credit for that actually goes to the support we received from the INSTI and from the alumni team. So we would like to present Otanka, who's our alumni Seki, with a small token of our appreciation.
Would like to mention Preeta, thanks a lot. Ankita, thanks a lot for your effort. You know, when you start something, something new, either you face obstacles or you get encouragement, inspiration. In our journey, the short journey we had lots and lots of, let's say, encouraging moment in the form of the alumni team. You know, we just came to our campus that we need the place to conduct our finals. They said, we'll give you more, right? So this has been an emotional journey for us also. And I was not amazed, because when we did the assessment, right, we had associate professors, researchers, they said, you know, that these kids are doing amazing work and we are surprised. My thing was, I'm not surprised. It's all about giving them exposure. You just channelize the energy and they can work wonders. So today I was looking at the audience, I was looking at the parents' face. You know, there was expressions of pride, they were anxious, and at times they were confused also that I have no idea what these guys are talking about. In the sense, you know, the numbers that they were talking about, EBITDA, your, what all did they talk about? I can't figure out. So, but it was extremely technical. The whole point is we wanted our students to give exposure to core finance, right? It's not just savings account or fixed deposit, but let's say IRR, ROI, right? Few of them, in fact, a lot of them are in class 9, right? So they haven't even studied accounts. Some of them are from engineering background, but they did brilliant work, and it's not just how they carried themselves here today while giving the presentation, right? We've been amazed the way they've been following up with us. So so I was a part of an assessment panel, right? So I asked a question. The student, I think at that time wasn't convinced with her answer. She called me back, gave me a message, sir, actually I meant this. So the kind of involvement was amazing, and it has given us a lot of encouragement to take it to greater heights, and we would do that, and we'll make it a national annual event and many more. Thanks for your support, guys. Thanks a lot.
Finally, Anuj. Anuj, can you step forward? Anuj, as you must have seen, he's a razor sharp mind, but he's also a very kind soul. And I thought he was the best person to judge these kids on a journey which must have been new for them. Thank you, Anuj. Thanks so much.
First of all, I think what Faz said, just to reiterate, I think it was very difficult sitting here. And I think there was no way to judge between the 9 teams, so all of you should be extremely proud of yourself, isn't it? I don't think I could have done that presentation when I passed out of IMP, isn't it? And I'm into investment banking, so that's my day job, isn't it? So, but I don't think I could have made half those presentations when I passed out. So, and more than the presentation, I think there's a confidence all of you had just presenting, isn't it? That's the biggest skill set you need in today's world. And even what Joseph sir was saying, I think somebody asked the question around the job opportunities. Like I have been in investment banking. Rashmi, my wife, she's also IMB. We met here. She worked with McKinsey Consulting. Faz was also consulting, A.T. Kani. I think our Indian education system is very myopic in the sense that you want to be engineer if you want to go to finance, but majority of the people around us, well, all coming from liberal arts, people who've done literature, PhDs in history. I think it's just the way, the mindset you think about. And I think that's what these kids are doing. So I think those courses are amazing. I think me for sure, when we were an IMB, I thought OB was the worst course, because why does, as an engineer, 2 + 2 needs to be 4, it can never be 5. But when you go into and work, I think all of us realize, I think those are some of the most important courses out there. So, but best of luck to you guys for the future. You guys are doing amazing, and where you are today, I think there's only more future to go front for you guys. Okay.
Lunch is at MDC Woods, which is inside the MDC complex, but it's like a nice open air area. So we'll meet you guys there, and then we can discuss. Thank you everyone. The kids know now.
Word of thanks. We missed very important component. Yogesh, thanks a lot. You've been really helpful. Yogesh is a PGP1 student here, right? So he has helped us throughout. And Priyanshi, I guess, is not here, but share our, word of thanks to her also. Thank you guys.